Good morning, good afternoon, and good evening, depending on where you are in the world. I know that it is super early for some of our colleagues, so super good morning to you, and thank you for joining us for the first ever Sub-Saharan PPP Day, hosted by the World Association of PPP Units and Professionals, WAPP. My name is Prima Tugonza, and I have the privilege of chairing the Africa chapter of WAPP. I will also be your Master of Ceremonies today, and it really gives me great pleasure to welcome you to this action-packed day. Our theme for today is financing public-private partnerships in Sub-Saharan Africa, creating value for people and value for the future. We have a total of 6 sessions of 1 hour and 15 minutes, 1 hour, 15 minutes each, yes. We have speakers with great depth of practice on the African continent. 96% of them are actually Africans and 40% of them are women. So we're very excited about that. We shall also have a networking session at 1:30 p.m. in which we will speak all things career from WAPP officials, and you're very welcome to join that session. So buckle up, you're in for a very good ride, a very great day of conversation. And of course, before we kick off with the keynote panel, please help me welcome Ziad Hayek, the president of WAPP, as he gives us some welcome remarks. Welcome, Ziad.
Good morning. Thank you very much, Prima. And welcome, everybody. I add my welcomes to Prima's. Delighted to have you here. Hopefully, you'll find the day useful. Before starting, I want to thank Prima Tugonza for taking the leadership to organize this day, together with Jyoti Bisbee, without whom none of this would take place. Amazing job also by our executive director, Jean-Christophe Bart, and contributions, significant contributions from Max von Abendroth and Johnson Kilangi. Thank you very much, team, for everything. WAPP is a hub for PPP professionals. We bring together people who are involved in PPP from all over the world, be they government officials or investors or consultants or sometimes academics and students looking to learn and do research. The important thing about WAPP is to create this network of professionals to exchange information. The 2 main objectives that we have, the first one is to service the needs of our members through the networking, help PPP units find investors, help investors identify projects, and consultants and other professionals find jobs or develop their careers. The second main objective that we have is to advocate for better PPPs, making sure that PPP profession stays highly regarded, few mistakes in PPP projects, as few as possible, making PPP really the engine of growth for the world that it was intended to be. And as you know, the SDGs, when they were first adopted, everybody knew that the Sustainable Development Goals could not be financed by professional, by government funding only. The private sector was expected to play a huge role in this. Probably like 2/3 of the financing of the SDGs was supposed to come from private sector. And yet we don't see that happening. Unfortunately, PPP, which is under Sustainable Development Goal number 17, is playing a small role comparative to the expectations that the world had for the private sector. This has a lot to do with a number of reasons. Africa is not different from other countries in that respect. It has a lot of the challenges that are faced by other emerging markets. The difference is that Africa's growth is tremendous. It outstrips, especially population demographic growth and other, outstrips all the other indicators for other emerging markets. And therefore, the need for developing infrastructure is so great in Africa. Therefore, this is why we at WAPP are focusing, giving Africa a tremendous focus in everything that we do. If we look at renewable energy, for example, 96% of all investments in renewable energy in the United States and Canada are done by the private sector. If we look at Africa, that figure drops to 18%, actually even less, 14%. So why is it that the private sector can finance 96% of renewable energy projects in North America, but only 14% in Africa? Obviously, there are many reasons for that. Certainly, it is not that African countries don't have proper PPP legislation. Most countries have now adopted PPP laws. Certainly, it's not because they lack PPP units. Most countries today have PPP units, and they have very highly trained professionals with CP3P certification and other. So what is preventing the development of PPP in Africa? Well, of course, a number of things, not only one aspect, perhaps political involvement and championing of projects by politicians that are aware of what is PPP and how it functions, so that they can, put realistic expectations and realistic objectives for their PPP units. Some of it has to do with the low quality of the consulting that is available in African countries. A lot of the consultants may have a lot of training, but no real hands-on experience in PPP projects to actually really make a difference in helping the government's structure and develop and actually get financial close of PPP projects. Some of it has to do with the lax approach to de-risking. The multilateral development banks maybe can and should play a much more important role in providing de-risking as opposed to providing financing. Limited capital resources. We all know this is something that all emerging markets suffer from, Africa perhaps even more than others. But we cannot wait to have other countries fund African development. If we look at climate funds that have been pledged for fighting climate change, only 18% of the funds that have been pledged by developed countries to fight climate change have actually been disbursed. So if they are not disbursing those funds for their own benefit, one cannot really expect that they do a lot more than that for helping other countries, regardless of all the conferences and on all the exhortations and all the speeches and all of that. We have to be realistic. At the end of the day, Africa has to develop its own capabilities, to develop its own infrastructure. And renewable energy is today, together with agriculture and other sectors, these are sectors that can really make a difference, and they are smaller projects that can be funded with smaller capital outlays, local capital outlays, just like countries like Kazakhstan or others are really relying on their local financiers to come up with. So how do we do this? How do we bring this financing? How do we energize the effort to finance PPP projects in Africa? Clearly, developing local capital markets is very important. Clearly, the multilateral development banks need to play a role in that. But there are other things that need to be done as well. Starting small is one of them, like I said. But it's not about other people saying what should be done. It's about African specialists, African nationals, people with experience on the ground to determine how best this needs to be done. So we need African solutions. And this is why we at WAPPP today are bringing together a fantastic group of the best minds on the continent with experience in PPP and other specialties, together with some of the most knowledgeable socioeconomic experts, to have this conversation, a day-long conversation, exchange ideas, see what can be done, how can it be done, and then determine, whether we as a community, we have a role to play in that and how we do it best. So thank you very much for joining us. I hope you find the day to be useful, and welcome again. Prima, over to you.
Thank you very much, JC. Ziad, clearly, same person. Thank you very much, Ziad. And at this point, and I think you mentioned that indeed today our key role is to bring together African professionals, African resources, Africans themselves to discuss what are the solutions for Africans when it comes to financing of PPPs. At this note, I'm going to, we're 3 minutes early, which is a very good thing. I'm sure they'll be eaten up at some point during the day. But at this point, I would like to welcome you all to the keynote panel. And I will moderate this keynote panel. If you just joined, my name is Prima Atugonza. I chair the Africa chapter. I also work with the Africa Legal Support Facility as the head of the PPP portfolio. And I have the privilege of chairing our keynote panel today. So this panel consists of high-level officials from key institutions involved in public-private partnerships in Sub-Saharan Africa. The panel will provide a strategic view on financing of PPPs in Africa. And of course, we're going to focus on the current challenges. As you are going to see, we have a very diverse panel that brings together very different views to the table. We will talk about traditional financing, but we'll also go into more innovative solutions such as, of course, impact investing. We have a lot of talk about philanthropy and the role that it plays in financing of PPPs today, but we'll also discuss how do you finance climate resilient projects within the landscape of the African continent. At this point, I'd like to introduce the panel. I will start with Rauna Mukumangeni, who's the director of the PPP unit, Ministry of Finance and Public Enterprises, Namibia. Rauna is a certified PPP professional, and she's responsible for proactive interaction with the government stakeholders with a view of identifying potential PPP projects and providing guidance on best practices related to PPPs, as well as development of PPP project concepts. She is the lead reviewer of transaction advisors analysis and project reports submitted to the PPP committee, and is also responsible for facilitating the development of PPP regulation, standardized provisions, resource mobilization, development of the PPP capacity building, and engagement with DFIs, amongst others. Welcome, Rauna, and we're looking forward to hearing your view on the public sector. Welcome, Rauna.
Thank you.
We'll also have Salim Fakir. Salim is the Executive Director at the African Climate Foundation, a strategic grant-making foundation focused on climate and development issues on the African continent. Prior to establishing the SEF, Salim served as the head of the Policy and Futures Unit of WWF South Africa for 11 years. He worked as a senior lecturer at the Department of Public Administration and Planning and as an associate director for the Center for Renewable and Sustainable Energy at Stellenbosch University. Prior to that, he served as the director of the World Conservation Union South Africa for 8 years. Welcome, Salim. I'll move on to Bathil. Bathil is the head of division at the OECD Development Center. She oversees its work on philanthropy, gender, and private sector. Bathil launched NetForward, the OECD network of foundations working for development 10 years ago. She brings 20 years of experience in development at the UN and the OECD. Welcome, Bathil. We're looking forward to hearing from you. And last but not least, welcome with me Moshood Bode Abolade, who's an investment director in Africa 50's project development team, and he's responsible for managing early stage infrastructure projects. Prior to Africa 50, he worked as an investment banker, advising clients on project finance, mergers and acquisitions, and PPP transactions in the infrastructure, oil and gas, real estate, and public sectors. Moshood was the pioneer head of project and structured finance at Coronation Merchant Bank and has worked at institutions like FBN Merchant Bank Limited, formerly FBN Capital, United Capital PLC, and Betiba Capital Management, all in Nigeria, as well as the AES Corporation. Welcome, Moshood.
Thank you very much.
Pleasure. And right now, before we jump into the questions, I'd like to request us to please put your questions within the Q&A chat. We're going to have a session in which we ask questions from the audience. So please feel free to put your questions there. If you're not shy and you're bold enough, please raise your hand. You will be given an opportunity to ask your question. But at this point, I am going to go straight into the questions for today. And our first question goes, despite global interest in investing in Sub-Saharan Africa continuing to increase, the use of the PPP model to finance projects in Sub-Saharan Africa has continued to struggle. So from where you sit at all your different tables, what do you think is the reason for this? Why do we have interest increasing, but the use of the model, we do not see concurrent increase in that? We'll start with you, Rauna, and then over to you, Salim. Over to you, Rauna. Rauna seems to maybe be having network challenges, so I'll jump over to you, Salim.
Thank you very much, Prima and Ziad and many others who have convened this session. It's really important. Firstly, I want to say that as the African Climate Foundation, we are not implementers of PPPs, but we are at the nexus of many of these issues because of the work we do in the energy transition space. And so the public-private partnership model is very important. And one of the reasons is that we, as ACF, been very active in the Just Energy Transition Partnership in South Africa, which will have to look at PPP models going down the line, given that we have raised about 8.5 billion for the JETP. South Africa has raised this through International Partnerships Group. But there is room for, there is a need, let's put it this way, for much more capital that needs to be allocated for a long-term transition process. So there are lots of lessons that we've learned from two processes in South Africa that I think is relevant for the rest of the region. The one is the very successful independent power producers program, which I also had the privilege of working with on many years ago. So it's very important to look at the procurement design and how that, if you want, public-private partnership model worked in South Africa. And then there is taking lessons learned from the WAPPP in South Africa to the investment plan that needs to be rolled out for the Just Energy Transition Partnership. I want to go and say that on the continent as a whole, if we go beyond South Africa, if we look at other areas that we are currently involved in, like Senegal, Nigeria, Egypt, and many other places, there's going to be a big demand for financing and innovative financing models. PPPs themselves will have to perhaps also look out of the traditional approaches. But what we are finding that even though there has been a dearth of PPP projects, I would say that largely that is driven by sort of negative sentiment rather than necessarily constructive engagement at the political and other sphere to construct mechanisms and innovative institutional models that can coordinate, if you want, the right political will and policies with innovative financing instruments that can enable both public and private partnerships to work in a very aligned way. So I'm not so skeptical about PPPs and the ability to take off. I think there are more important issues around. For example, it's more easier for private firms, particularly mining companies, to construct infrastructure from mine to ports. Then there is a willingness for the private sector to get involved into more network infrastructure that are also public goods and services that have to be delivered to society. So we have to find ways of, I think that the issue of debt distress in Africa is going to be an important issue. But at the same time, we have to try to find institutional models that can bridge the divide between public and private interests, which is something that we are going to discuss here at this platform. And what we have found, for example, UCT has done a very important study on the expansion of IPP programs. The role of development finance institutions, including philanthropies, which have philanthropies in our case have more flexible funding. And by the way, on the continent, particularly climate philanthropies have been making very small investments in the past, and that's going to grow. And largely, that's a role that we see as ACF to be able to help governments and other parties to put together packages that have a couple of ingredients in them. One is the necessary political coordination. The other is to look at the macro fiscal situation in countries, because many of these projects would require some form of guarantee. It doesn't have to be provided by the state. There's even discussion in South Africa where the state guarantees are necessary for PPPs to get off the ground. But that might relate to particular well-developed and mature technologies where PPPs are probably not necessary. But this is not necessarily true for other parts of the continent. And then to have programs where we can design both policy reforms with a finance package that can involve international partners, with the last part, long-term visibility on the investment portfolio that can evolve out of investment plans that requires both public finance and then also private finance. The main challenge I think that lots of PPPs will face, particularly with public infrastructure that cannot really be funded on the balance sheets of firms, but have to be funded by the budgets of states, is ensuring those infrastructure investments lead to stable and sustainable growth that over time raises the national income and the income of both firms and households that can pay for the infrastructure over time. As you know, we have a huge dearth of electricity on the continent, and we need to grow that in order to be able to unlock more economic potential. So I would say that let us really not run with negative sentiments, but rather think of the challenges, unique challenges on the continent, and let us be innovative in how we create institutional and other models to make things work. Let us go with a lot more positivity, even though those conditions are tough on the continent. I do think they are workable approaches, and the timing for that is probably more now than ever before. Even crisis enable you to do some remarkable things that you may not be able to do if there were no crisis. Thanks.
Thank you very much, Salim. I think what I'm hearing from you is really the negative sentiments that are on the continent. Despite other challenges that we could be addressing, there's still a lot of negativity about the PPP model, and that has gone into influencing why we have less PPPs on the continent despite interests. I'll come back to you, Rauna, from where you sit at the PPP Directorate in Namibia. Whilst you have very many investors trying to invest in Namibia or even on the continent, in your experience, why don't we have corresponding PPP projects?
Thank you, Prima. Apologies for that. I was experiencing some technical glitches, but that is all sorted now. I think that firstly, SSA governments need to appreciate fully the efficiency of involving the private sector in PPP projects. Multiple factors, however, contribute to investment or financing, and this may differ from jurisdiction to jurisdiction. From what I have gathered, and several reasons that have been cited include, but are not limited to what I'm going to mention. Some of that will be political stability, political interference, political support, institutional factors that range from capacity, both at governance, institutional and public enterprises. And PPPs being complex in nature, they require a well-skilled resource in terms of technical expertise, and the absence of legal and regulatory framework in some jurisdiction is also a contributing factor. Other reasons that have been cited are the transparent evaluation and competition, and standardized procedures in terms of that would increase efficiency of project preparation are also cited. However, in the Namibian context, I would say, in as much as some of those might be also applicable to us, for us, it's more of a lack of bankable projects. The lack of bankable projects, which is attributed to a lack of capacity and just a buy-in from all the stakeholders that are involved.
Thank you very much, Rauna. And I would agree that that's the story of very many African governments that are trying to get involved in PPPs. There's really a lack of bankable projects. The projects are there, but the work that's needed to actually make a project bankable is what's lacking. I'll quickly move on to Bathil. From where you sit at the OECD, your work in philanthropy, why do you think we do not have corresponding projects despite a lot of interest to invest on the continent?
Thank you very much, Prima. Thank you for having me. So my name is Bathil Misika. I work for the OECD Development Center. We have both a network of foundations working for development, NetForward, and a Center on Philanthropy, which collects data on philanthropy for development in a way that's comparable to ODA. So what I wanted to share with you is first that actually I wanted to look at the data, what available comparable data tells us. So first, it seems that private philanthropy doesn't really engage in PPPs. And the engagement of private philanthropy in PPPs, as I said, is marginal. I'm going to try to share my screen to show you, well, oh, fantastic. Jean-Christophe is doing it for me. So if you can put it in full screen, it would be fantastic. So look here, this shows you, so the amounts that are being spent in PPPs with philanthropic funding and how much basically is allocated, sorry, how much is being spent and how much is allocated to PPPs. So you see that in spite of a hike in funding in 2019, the proportion remains relatively stable, which then goes back to what my fellow panelists were discussing just now and what Rona was reminding us. It is up to other factors. It is not just about the availability of the money. So I think this is lesson number one, which is quite important. That said, I'd like to bring a bit, a glimpse of hope to that narrative. Basically, our database shows that there is potential because unlike what we see in other geographies, in Sub-Saharan Africa, philanthropy invests in low-income countries. So if we can see the second slide, that would be fantastic. And I think this is a very important one. Jean-Christophe, if we could have the next slide, please. Fantastic, thank you. So you can see here, so we represent cross-border philanthropy. So philanthropy that comes most of the time from the north to the south in green and domestic in orange. So you can see in the rest of the world, and this is what I've been saying in like dozens and dozens of occasions, philanthropy usually funds middle-income countries. However, in Sub-Saharan Africa, we see that is not the case. Cross-border philanthropy funds low-income and lower middle-income countries. So technically, that opens up a lot more opportunities, including to engage as part of PPPs with ODA donors, with ODA capital, because ODA capital flows in a concessional way much more easily towards low-income countries. However, as we've just said, in low-income countries, you're not going to have the same institutional stability and the same capacities. So, on the one hand, it is encouraging to see that there could be that potential, but, but it's still not happening. So you would need to ask me now, what do we need to make PPPs more attractive to foundations? So what is needed on the government side to make PPPs more attractive is, what we've just heard, more stable governance And I would say that if I wanted to summarize it, capacity at 3 different levels. Capacity develops, through 3 entry points. The enabling environment. So the enabling environment includes governance, rule of law, regulations, capacities at large. At the organizational level, organizations themselves need to be equipped. It's not enough to just train PPP professionals. So you need to have organizations that are robust enough in an environment that is seen as reliable and stable enough. And finally, the individual. You need to train people, professionals that can then, move within that environment. Now you would say, okay, whose responsibility is that to strengthen that capacity? Well, it's a bit like development these days. It is not the responsibility of only one set of actors. But we do see, having observed philanthropy for development for a long time, that it has not really invested in developing government capacity to the extent that we could expect it to do that. I mean, we could go on about why philanthropy hasn't really supported capacity development. I think that would be for another conversation, so I'll stop here. But I think the message is clear. Not enough PPPs in Sub-Saharan Africa. However, there is potential, but capacity stands in the way. Thank you very much.
Excellent, Bathil, and thank you for summarizing it for us so succinctly. I'll quickly move on to Moshood. From where you sit at Africa 50, why don't we have corresponding investment in PPPs?
Thanks, Prima. I think as an investor, I'll try to focus a bit more on, Rana's point on lack of a sustainable pipeline of bankable projects. Right, and by bankable, what we mean is a project that from the lens of every stakeholder, they can say that this project has been well developed, right? And what are the issues, right? The issues are why projects don't get developed, and it's also important to note that only 80% of projects actually get to financial close. So some failed, some get delayed, and this process typically would take anywhere from 3 years to 8 years. So when you start to see that there is investment available, but it is not going into this project, these are the high-level sort of factors that contribute to this. But the secondary level factors or things that affect it, I think has been sort of alluded to by everyone, right? Things around, lack of capacity, both on the government side as well as, the private sector in terms of having local sponsors being able to develop these projects to the point where they are bankable. There are also issues around, regulatory environment and ease of doing business, which I won't belabor. There's also the lack of that financing. So when people say that there is investment for well-developed projects, right? But we don't see investment to fund the early stage activities that actually help you establish bankability, right? So when you consider all of these things, and there's also the issue of, we have, sovereign states with weak balance sheets and, counterparty viability concerns, in these countries that sort of, don't help the structuring of PPPs. There are more, but just as there are more problems, there are solutions, because we've seen that, countries with enabling environments as well as, good ease of doing business, being able to attract more investment than others who have not. And, the reason is clear. Investors want to put their money, into assets where, for the risk that they're taking, they're able to earn a decent return and obviously create some impact, because I think today, impact is inevitable when you're investing in infrastructure. So to sort of put things in perspective, I'll just quickly scan through, the project development process so we can get an appreciation for, when and, why these projects fail, right? It starts with, project definition or conceptualization, where, either the government or private sector has identified a project and has said, this is a priority for us, either because there is a clear need for it by our people or it is part of a broader infrastructure master plan. And then you move on from there to, determining project feasibility, across various lenses, legal, environmental, and social, financial, engineering and technical, and others. And then, it is, once you're able to tick all those boxes around feasibility, then you can then say, this project can then move on to structuring, where, all the risk transfer happens, right? And it's the sweet spot where you can then say, I've been able to achieve bankability. And what does this do for you? It helps you usher in the required financing to construct the project and be able to operate it, right? Even though I've summarized this in just a minute, right? The truth is this process could take anywhere from 3 to 8 years, as I've noted, and it could cost anywhere from 12 to 10% of the total budget, for financing the entire project. And this percentage, if Africa is to meet its infrastructure deficit, if it's to cover that, would be around $2.5 billion every year. So, and which is a multiples of the available funding today. So now we see, when we look at this process, we're able to say, if a project, is not part of a plan of the infrastructure master plan, or is not a priority, it's definitely going to fail. If you are not able to sort of tick the environmental and social, impact box, then that project is likely to fail. So this is where it is along this value chain that the issues sort of stem. But I think all in all, we want to be able to reduce this 80% to the barest minimum. And how we do that is we need to ensure that there's efficient risk transfer between government and private sector. Government should be able to take risk around changes in government or law, backstop counterparty risk, and other sort of government side force majeure. And then the private sector as well needs to be able to take a long-term view around infrastructure assets, given their very nature. Enabling environment is another thing. I think this has already been touched on. And then adequate financing for project preparation and development. This would help you unlock things like improving technical capabilities and capacity, and also help government to prepare projects for tendering, as well as all the other aspects around project feasibility and structuring. I think ultimately, I think I've mentioned this before, there needs to be a very good process for assessing projects that are suitable for PPPs, even before they leave, the government project book or project list, to ensure that, they are commercial, they can be properly structured to be viable, and, they are part of, a master plan, or there is a clear need for these projects. Thank you very much.
Thank you very much, Moshood, spoken like a real investor, and we will be back. We're going to circle back to you and some of the statistics that you have given us about financing and dig a little bit into that. But before we go on to that, I'd just like to point out that we're having a technical issue with the chat function. So if you have any questions, you'd like to introduce yourself, you'd like to say where you're coming from, please just put it in the Q&A box. We shall try to sift between the questions and also the introductions, because it's very important for us to know where everyone is coming from. So very quickly, I'll run to you, Rauna, back to you, Rauna and Moshood, simply because of the sort of space that you're involved in. And Moshood, from where you speak, you say that a lot of investment is needed in project preparation. This is while Batil pointed out that there is money, there is philanthropy money for to fund this project. There are other issues at play. You also point out that the money that's available is really for bankable projects, and there's an issue when it comes to project preparation. So that brings me to my next question, and that is that many opponents of the PPP model claim that PPPs are in fact more expensive, and it seems to appear that they're in fact more expensive than traditional financing. And so sometimes they may not really provide the value for talk about in the long run. So based on the projects that you have been involved in, as well as the project preparation process for both you and Rauna, is this the case? And if so, what has contributed to this? What models of financing do you think should be employed to render PPPs less expensive, of course, in comparison to traditional project procurement? I'll start with you, Rauna, and then I'll quickly run to you, Moshut. Over to you, Rauna.
Thank you once more, Prima. I think that by definition, PPPs are not expensive. It all depends mainly on the due diligence, as Moshud has alluded to, that a proper feasibility study in terms of legal, technical, financial, and environmental has to be done. And only once a project has ticked off all the boxes that it should be done on a PPP. Obviously, if a project has been assessed in terms of, and a public sector comparator is done, and it's seen that the results point to the fact that it can be done on a traditional procurement because it shows more value for money, then it should be done on that instead of just doing it as a PPP just for the sake of it. So it all boils down to due diligence done. And I would like also to add that I think really Moshut has mentioned all of the things that most of the reasons have been attributed to higher cost of capital, operating profits, and transaction costs due to the nature of PPPs and requiring that if it requires that a PPP has financial, a private sector being the one that is responsible for the financing, then obviously government is in a better position and borrows next to nothing in terms of interest rate. So private capital is much more expensive, and the private sector is in the business of making a profit. So we just have to match the interest of government in terms of it delivering an efficient service against what the private sector requires out of that. And PPPs are capital intensive, and as I've said before, they require highly skilled workforce, and this also adds to a premium because the private sector is not coming on board if there are no returns, potential returns from the project for them. So that is costed, but it's costed in terms of a risk premium, but one can also argue to say that the risk that government takes on in terms of being in project, if one has to take, if one has to compare when the government does the project by itself, it's taking on all the costs, all the risks, financing, preparation, and everything. And most of the time, because government is not getting paid, not most of the time, actually government is not getting paid. So that cost is not remunerated. And as such, it's not factored into the total cost of the project. Whereas the PPP factors a whole life cost of the project, construction plus operation phase. So it's easy for one to look at that and conclude that PPPs are more expensive. However, empirical studies have been done in countries like the UK, and it has shown that some PPPs did not show value for money, but in the same jurisdictions, it has also come to light that some of the projects carry, show a positive value for money. So it all comes down to, in the end, to how well projects are prepared, and that only bankable projects that show a positive cost-benefit analysis and a positive net present value should be taken through to a PPP. If they can be done on traditional procurement, then obviously there is no need for a PPP. So I'm really just underscoring that. And then it's also possible that all of that can be done, proper due diligence can be done, and then a project is implemented. However, during the operation phase, because government is still responsible for the monitoring and evaluation, if it takes a backseat and it doesn't do a proper contract management, the value for money aspect can still be lost. So I think, like I've said, PPPs by definition are not expensive. So it all comes down to how well a project is prepared. And if it ticks off all the boxes in terms of a traditional procurement, then it's not valid to do it as a PPP.
Thank you, Rauna. And I think that's a very, very brilliant answer in terms of where you seem to say we are comparing apples and oranges, right? If it's a PPP, then we should not even be talking about public procurement. So we should not even be comparing the financing because it's a totally different ballgame. Moshood, very quickly, what do you think, is this, in your opinion, having looked at the figures and having seen the actual investment that goes into PPPs, would you think that they are more expensive, or like Rauna says, we should not even be having the conversation?
Yeah, I think I would sort of align with Rauna's position. I think to answer the question directly, I would say yes and no. And the reason is, there are certain projects that are not suitable as PPPs. So as you were saying, during the feasibility process, this has to be taken into consideration. Or even when you're doing project selection, there are certain sectors that today in Africa, they are not ripe enough for PPPs. So, you don't even want to go there yet, right? And there are projects where it's a no-brainer. The technology is there, the private sector can do it better than government, and they are better procured as PPPs, right? Value for money is an interesting concept, right? Because when you say yes and no again, right, it depends on who's looking. Right, if we take, for example, a toll road project, in any country in Africa that is being procured as a PPP, right, to the contracting authority, who is the Ministry of Transport or its equivalent, right, they are going to compare the private sector's proposal against whatever budget allocation they would require to implement this project. And as Rauna said, it doesn't sort of factor in the life cycle costs. Right, it is just the one-time capital expenditure. Meanwhile, the PPP might cost more just because it translates to lower cost of maintenance and lesser frequency of maintenance as well, right? And then when you then switch on to the user of the road, who has to sort of save money in terms of, vehicle maintenance or pay lesser tolls and lesser disruption to travel time, how do you quantify value to that user? Because they are a valid stakeholder in this project. And then when you then also, when you consider National Treasury, who is also an agency of government, but is responsible for whatever guarantees or contingent liabilities that this project might bring about, to them, if it is well structured as a PPP, these guarantees might not exist or negative pledges, because it has been commercially structured to require no guarantees. So all of these things are, it's hard to quantify them, but I think as we continue to think about, VFM and public sector comparators, these ideas need to be brought to the table. And I think there are also sort of, this is at the project level. There are also sector-wide implications. You're doing a PPP in a sector for the first time, right? There's a learning curve that you need to climb. It will translate into time and cost. And we all know that private sector, the way private markets work is, technologies get cheaper and cheaper as, advancements happen. So as the industry matures, what happens is investors have a track record to rely on, and they're able to price risk better. Cost of capital ultimately will then go down. Cost of operations will go down. And in that country, you can then start to say, we have an active private sector, a sector that exists beyond government in the transport space. So I think, all of this, somehow, some way have to be brought into the conversation when assessing value for money. Thank you very much.
Thank you very much, Moshood. And I think, you agree with Rauna that, we just can't compare the two. I will move to Salim and Bathil, and I'll start with you, Bathil. So what other challenges are you seeing as we're setting the tone for the rest of the day, and in the philanthropy space that you sit, apart from what we've talked about when it comes to enabling environment capacity, are there any other philanthropy specific challenges that you have seen to financing of PPPs on the continent?
Yeah, thank you, Prima. Well, I see two challenges, but one being much more acute than the other. Philanthropy is still not transparent enough. It's very hard to know who's doing what and where. You know, if you were thinking about it from a business perspective, is it as if you said, oh, I want to get into the sweets business in East Africa. You're like, okay, so what do people like? How are others, you know, penetrating the market? And you'd be like, I don't know, but I know that people like sweets. You know, this is insane. We have very limited data on philanthropy and how it deploys its capital. You know, we at the OECD are, you know, I've tried, we have a database and I'll share, there's a QR code, it's free, it's open, with about 210 foundations. We've been starting to look at domestic markets, but as long as you are operating in the dark, it makes it very difficult to find aligned partners. The second challenge, I would say, is that there is a nascent scene, especially in Africa, of domestic philanthropy. It's not as developed as in other geographies, but in South Africa, in Ghana, in Kenya, it's very vivid. However, we do realize that domestic foundations are still not seen as a primary partner, especially for PPPs. They're sometimes not connected to other funders. I'll tell you this anecdote. Yes, this is where you can see our data. I'll save the last slide for the last question. We're still seeing a lot of these domestic foundations not properly connected to the ecosystem, while they provide a great opportunity because they're well connected to the front lines. They know the ecosystem. They are already working closely with local governments at times. But I'll end with an anecdote. When we engaged in a dialogue with South African foundations, we had mapped South African philanthropy. We presented how much there is in volumes of ODA, of official development assistance to the country. And one of the local foundations said, oh, really? South Africa is receiving ODA? And we were like, okay, you know, that says it all. You know, there are silos. And I can tell you, you know, in the last 10 years, I've seen a lot of progress along many lines. One thing remains really quite saddening: lack of transparency to silos. Let's break these silos. It's like, you know, people that do not, these different groups of people do not talk to each other. It's a clash of civilization almost. And ODA and philanthropy, you know, the joke is that, you know, ODA donors think that because they've been doing it for a very long time, philanthropy should be just a big checkbook and give them the money so that they will know how to do it. While philanthropy says, oh, we're the cool kids on the block, we're new, we're cool. Well, you know, ODA, if you guys knew how to solve this problem, we would know by now. So why don't you leave it to us, the private capital? And, you know, the truth is probably somewhere in the middle, as it often is. So again, I see these challenges as transparency and better connecting domestic philanthropy on the continent to the broader ecosystem, especially when it comes to PPPs. Thank you.
Thank you very much, Patil. And I think in the last round, in the next, you know, just before I invite Salim, I'm going off script a little bit. I've just thought to myself that a lot of people on the webinar might be more conversant with traditional funding, and they might not know how philanthropy fits into and how philanthropy is becoming the fourth P. So maybe even as we talk about it, you know, as you speak specifically to the work that OECD is doing, I'll invite you to tell us just a little bit into how it fits in and how what are the returns. You know, as we hear Moshood talking about the returns and the money, how does the money in philanthropy make money? And so or does it need to? And so I'll just ask you to speak a little bit about that, so that, you know, even the PPP practitioners get a little more aware of how philanthropy plays a key role. Over to you, Salim. On your side, what are you saying?
Thank you very much. I listened to Patil very interestingly. I would say that I do think many of the points she raised are very important, but I don't think it captures actually what is evolving, because the landscape is changing. And certainly where I sit as the African Climate Foundation, I do think that there's a need for a lot of engagement with the principals, the top honchos of philanthropy institutions around, particularly issues around Africa. So let me give you some insight. Of the $700 million or $1 billion that is allocated to climate work in the world, only 2 to 3% is actually comes to Africa from philanthropy. So that I would say is going to change over time, and there are a number of reasons for that. There's huge. There's a different role for philanthropy than the classic type of climate philanthropy, which has been more invested in ecosystems around sort of rights-based approaches, activism, campaigns, but not enough around economic solutions. And I think you will find that even, for example, you will hear later from the Global Alliance for people who are looking at energy access and ourselves, are actually looking to innovate new approaches to unlock larger. You talked about ODA. We think that ODA can be brought into the picture, even private funding, if we can work with government to set up innovative quasi public institutions that can coordinate government interest around public investment, particularly in infrastructure, and then be able to do the technical work and also be able to put together the finance packages that can look at both bilateral funding from development finance institutions, multilateral development institutions, and allocations from ODA allocations, which is diminishing on the continent. So we can forget about ODA solving our problems in the long term. We have to find internal resources within Africa. I do think that I think there's education that's happening with domestic philanthropies, Batil. And in fact, we are working, I presume we've been working with IPASA. We've been having engagement over the last 2 years. And I think there's an evolution going to happen within the philanthropy space. And we have to do a lot more harder work, even us as a philanthropy institution, to bring sort of the climate development nexus work a lot more closer than it is at present. A lot of philanthropy funding goes to social welfare causes in which the state is not delivering services. In fact, in a country that is as rich as South Africa, lots of municipal functions don't work. And in fact, philanthropy is asked to step in. So I'm not so sure that the narrative is as negative that your stats may show, Batil. But I would say that the picture will improve over time. And I think that the work that we're doing, for example, also with other philanthropies, GEP and many others, Bloomberg and others around the JET-P models, which try to consolidate what they call country platforms to make more visible long-term investment needs in the country to resolve, for example, both energy crisis and decarbonize economies. We have to couple climate with development objectives. That's what we really need to do. And philanthropies have the ability to work very flexibly. And we've shown it, by the way. It's not something we were doing theoretically. We've actually done it. And we were doing it in other countries, including Namibia, Runa, with the implementation authority around green hydrogen. Their philanthropic support has been very important. But philanthropy can't be involved at the level of PPPs where you need large-scale capital. Those are resources beyond the capacity of philanthropies, including individual philanthropies and so on. But we can sort of catalyze and kickstart processes that then can make the case for larger investment pools to come into play. And I think we think that there's a lot of progress that will happen and is happening already. So I'm not so skeptical about philanthropy. I do think that we have to mobilize more African-based philanthropy. We cannot rely just on northern-based philanthropy. I don't think politically it's also acceptable that that's the case. So we also have a tough task ahead of us to make sure that African philanthropy plays a bigger role on the continent than it is. And we have to show by example, not just by theory and abstract. We actually have to do these programs on the ground to show how philanthropy can occupy a particular useful space and then be able to move forward on the sort of larger canvas of looking at the relationship between public philanthropy and other private capital to fill gaps where they're necessary. So on the issue of transparency and data, I think particularly in the climate space, I don't know if you talk to Climate Works Foundation, Batil, they do a lot of data. Maybe they're not giving you what you want. But I don't think you will find, frankly, lots of philanthropy actually working at the intersection of climate and development. That is something that's evolving. And that's one of the reasons why we would not see such large-scale investment from philanthropies in the unlocking PPPs, because that's really the role we can do. We can't subsidize and de-risk projects for private profit. I think that will be totally unacceptable, and I think we must put that as an issue on the table. We have been meeting lots of people who are looking at blended finance, and when you actually look at who the beneficiaries are, it is the parties that are going to benefit from ways that I do think that would arouse controversy, and it will not be acceptable for philanthropies who are there to really promote social welfare and social justice to be seen to be subsidizing profit-taking by reducing risk for parties that themselves, if they're not wanting to take the risk, don't get involved in. Lastly, I would just say, just on the PPP models, one can separate into two types. I think for competitive technologies like renewables that are done on a modular scale, if you run a right procurement process, you can get the best price in the market. That's also true for green hydrogen in terms of wrapped projects. It's more difficult for PPPs to have control over very large-scale mega projects like nuclear plants, large-scale coal plants in the range of 6,000 megawatts. There's potential for PPPs to shift the risk onto the state because those projects are notoriously known for running over cost and are not being in budget, and often, as you've seen in South Africa with some coal plants, after many years of development of these coal plants, they are still in a rut. Many of them are not generating power to the level they are. So it's very important that we unpack what we mean by which types of PPPs for which types of projects in order to be sure that we can get the best price out of them. Thank you.
Thank you very much, Salim. And I'm sure Batil has some responses, but she'll get an opportunity to just respond to some of the points raised. At this point, I'd like to move to speaking solutions. So I think we've set the context. We've set the context in terms of what is the data, what is happening, do we have an enabling environment, but now would like to see what your different institutions are doing in terms of providing a solution for financing of projects on the continent. I will start with you, Moshood. We, in terms of, Africa 50, we know was set up with the aim of bridging Africa's financing gap. So what solutions is Africa 50 actually proposing to the challenges that we've all spoken about currently being faced by financing of projects on the continent? Moshood, let's hear what's Africa 50 doing.
Thanks again, Prima. I think for the benefit of all on the call, in the session, Africa 50 is an infrastructure investment platform that has been set up to increase the pipeline of bankable infrastructure projects on the continent. We are in our 7th year of operation, and we have as shareholders 31 sovereign African governments, the African Development Bank, and 2 African central banks. And our we operate mainly, via two separate but complementary entities called Africa 50 Project Development and Africa 50 Project Finance. The latter entity is charged with investing in equity in projects from financial close through to operations, providing capital for construction and expansion of infrastructure assets. The Project Development Fund is charged with investing in early stage development activities, the activities I described earlier. And this is, the vehicle that we use when it comes to PPPs. We also recently launched, what we call the Africa 50 Infrastructure Acceleration Fund, which is also a later stage fund, but, does larger tickets and is a private sector funded vehicle. In terms of PPP solutions available, at Africa 50, we do, intervene in PPPs in a number of ways. But it's important to mention that we take a project focus, and we have what we call the surrogate sponsor approach to developing PPPs, where as financial investors, we will take on the driver's seat, speak to government and procure PPP projects, where we take the driver's seat, provide the necessary capital and expertise to take projects sometimes from concept all the way through to bankability, when we believe it is then ripe enough to attract private sponsor interest. And then we might run a tender or select a sponsor to continue or to complete the development and take on the reins when it comes to monitoring construction and operations of the asset, where we then take a minority stake. So we call that the surrogate sponsor approach to implementing PPPs. Secondly, we have what we call asset recycling at Africa 50, which is a very quick way of doing PPPs, and also a way of helping governments to immobilize operating assets that have been funded by private by public sector finance, essentially taking over those assets and providing some liquidity to the government to help them fund further infrastructure projects or other national priorities. And the idea behind this sort of solution is to help government, generate more liquidity to be able to, fund their social and economic development plans when it comes to infrastructure. In addition to those two, we also co-invest or support, sponsors that have procured PPPs from government via sort of legally permissible means. And we partner with the sponsors to co-develop projects and ensure that they get to financial close, where it can then attract private sector investments. So these are the major ways that we intervene. But we are more than happy to engage, if there are any other sort of areas where anyone on the call thinks there is potential for collaboration. In terms of sectors, before I close out, we tend to prioritize power, transport, ICT, midstream gas, fintech, healthcare, and education with respect to the infrastructure of these different sectors. Thank you very much.
Thank you very much, Moshood. And I think it's really important that Africa 50 is getting involved in investing in early stage project preparation, because in our experience working on the continent, that is the biggest problem. I'll move back to you, Bathil. And let's talk about a little bit about OECD's Net Forward. And we know that through this, you are promoting philanthropic funding for development. The question, of course, that was raised, I think, by Salim is, can philanthropy actually propose a solution for projects that are as massive and are as large scale as PPP? So from your experiences, do you see opportunities and barriers for foundations entering PPPs? Can philanthropy actually be a solution to the financing gap?
Thank you very much. Salim is absolutely right that when you look at what sectors philanthropy supports, so cross-border philanthropy supports primarily health and reproductive health, even when you discount the Gates Foundation. So first, it's not infrastructure. It's not going to be these large-scale capital incentive projects. Education comes second, and a very interesting finding is that in domestic philanthropy in emerging markets that we've been able to survey, education is always the #1 sector supported. Well, one could argue, why are philanthropies supporting these social projects? Well, because sometimes they need to step up for the state, but also, because of how they relate to their businesses. Also, I'm sorry to be a bit cynical here, it looks very nice on an annual report to have young kids laughing or taking kids off the street. This is probably sexier than the bridge, just saying. Now, going back to why would foundations want to engage in PPPs? What's in it for them? There are two main, the holy grail for philanthropy. It's to achieve scale and to localize. First, you could imagine that philanthropy they have to engage with others, and especially with governments, with public entities, to achieve scale. Also, if they read their Paris Declaration, well, they also do that because then they can align behind national priorities, behind local priorities. In other words, not become, this caricature of a supply-driven donor that just comes in and says, oh, here is what I think we should do because it's worked in another country or in another continent. And, foundations also need to engage with governments and other partners, private and public, because they want to maximize the impact of their investments. Now, what do foundations bring to the table? And that goes back to your question, Prima, what's in it for them? Well, you have as many foundation types as you have individual people. I mean, more or less, the joke is you've seen a foundation, a foundation when you've seen a foundation. It's like, they're all very different animals. That said, if I wanted to generalize, I would say they bring patient capital. There's a bit of hype around that. So I could argue that when we look at how long the grants are, it's a bit disappointing compared to discourse. But supposedly, foundations being disconnected from the political cycle, in other words, they're not like USAID, that's going to be bound by a political agreement with the government. They can engage over a much longer period of time, which is great for financial support and to be a credible PPP partner. They can engage in blended finance, providing first loss capital. I would disagree slightly with you, Selim. I think, a question we're often asked is it philanthropy if it actually generates a profit? Well, it depends what you do with it. If you invest in social enterprises and then, you take equity, and as they become profitable, you reinvest the profits in other social enterprises, I would say, for me, this is the best definition of a positive sum game. It's very important also in our awareness, educating about philanthropy, that we shy away from this zero-sum game. Oh, I have something, I have $1, I'll give you $1, now I have $0 and you have $1, even if you didn't need it, I'm gonna give you a pen so that you can write this great business plan, even if that's not what you wanted to do, and you'd rather type it on a computer. So the positive sum game, I think, is an extremely important feature that philanthropy brings. Now, the last myth that we always have to debunk is not just about the money. Philanthropic capital will not solve, and even we have to leverage it much more endogenously. So I think that we all agree on that. Africa, its domestic philanthropic scene will grow and will have to grow, and we're going to have to find ways to make the ecosystem more fertile, including in low-income countries. It can't just be the privilege of former Anglophone colonies that have achieved a certain development status. That said, we really need to also consider that philanthropy will not bridge that gap. When you look at volumes, think of ODA like an orange. Philanthropy is a P. So it can unlock, yes, it's a P. So, when I hear, oh, philanthropy, it's like philanthropy is tired of being seen as this big fat checkbook. It brings other things, it must be nice to be the smarter, most beautiful person in the room. everybody is always very nice to philanthropists and all, but they bring they're not just beautiful, rich. There are other ways. There are other ways to be beautiful than just being rich, and those ways are that they can pilot approaches. So that's because this is lost capital, and ODA cannot do that. This is taxpayers' money, especially now in this context. So they bring a capacity to innovate. They have connections. If you recall, venture philanthropy, besides the fancy name, is you bring financial and non-financial means. Meaning you help your partners, you provide them with business opportunities, with your networks, with marketing. So there are many ways, including through research, that philanthropy can bring assets to the table. So yes, checkbook, but not just, and just be mindful of what in your mind is the size of the checkbook, because it might be a little bit, not everybody's the Gates Foundation. And then finally, domestic foundations, they do bring, and I mentioned it, an understanding of the ecosystem. You see, if you want to fund the front lines, if you want to stick to needs, you cannot just rely on analysis that's done from 6,000 kilometers. The problem is, no matter how good international philanthropy is, most of the time it doesn't have local presence. Even, with the notable exception of the MasterCard Foundation that decided to deploy, they're in 7 Sub-Saharan African countries. Other, even Rockefeller or Ford, they have at best regional offices. So do you think they know exactly the nitty-gritty of what happens in Uganda when you have an office in Nairobi? No. Even if you rely on your partners, a collaboration with domestic foundations is going to be critical. And that's what we really want to put the emphasis on. This scene is largely underexploited in PPPs, in partnerships in general, and as co-funding partners. So now I'd like to finish with, going back to maybe this slide. I'm sorry, because it was shown a bit earlier, but if not, I can just speak to it. So I'd like to go back to the barriers. We've spoken about a lot of barriers, but basically it's hard to find partners because there's a lack of transparency. Foundations, when we survey them, and we do in our qualitative survey, they have come up with the following responses that some of them I find quite a bit disingenuous, but it's not me, it's what the data tells us. So this is for foundations that collaborate with other foundations, not even with governments or donors. So they say identifying funding partners with aligned interests is difficult, and those are for the ones who are engaged in collaboratives. They say also it's a lot of time and resources to manage a donor collaborative. Well, they're saying everything we know about partnerships. Yes, guess what? Partnerships, yeah, they take more time, they're painful, but getting there, there's a reason why you need to enter these partnerships, enter these PPPs. So they say it's burdensome, collaboration is difficult. We want decision making. This is where the human factor comes in. Don't forget that we are humans with egos, and a lot of foundations, especially from high net worth individuals, they come with egos. In a PPP, it's not all about you. No, please do not underestimate. We're human beings. We're not machines. It's not bots that do PPPs. It is human beings with logos, pressure to market. So I'm sorry, but we have to remember that and find ways in which some of these organizations can find attribution. It's always, how do you attribute versus contribute to results? So that's something we cannot ignore. And finally, establishing a donor collaborative is sometimes not facilitated by local regulations. So this was just an illustration to show you that, or within the same tribe, those are the difficulties that foundations claim to have. So when you actually have to work with others, not from your tribe, that speak other languages, that operate on different time frames, you multiply by 10 or 100 the difficulty. So let's look at, how we can unlock some of these difficulties. Transparency to me is a really big one. Capacity development is another one, but the advocacy and the conversation we're having today is very important. We need to start bringing people from these different tribes together to break these silos. That's the only way. If we just keep to ourselves, we will not solve anything. I'm happy to make the slides available. We have a database, it's free. It's accessible by all. It's a QR. It's on the QR code that was shown earlier. You can share it with participants, and I'll stop here. I would have many more things to share with you, but I hope that provided a little glimpse of the potential of philanthropy and what I see as some of the barriers we need to overcome. Thank you very much.
Thank you, Bathil. I actually think you've given us a crash course in philanthropy and what it can do and what it cannot do and how it is viewed and how it should not be viewed. I'm going to move on quickly. We have 8 minutes to the Q&A from, we have a lot of interesting questions from the audience. I'm going to start with you, Rauna, and I'm going to couple this with someone from the audience asked, can we do small PPPs? Are small PPPs available, like BOT for a small garden in a square? Is there a way of shortening the PPP process? And I'll couple that with, what are the innovative things that you think should be done by all the different players in the sector that could help governments do things like this, shortening the process, doing smaller value projects from where you sit? What do you think can be done?
Thanks, Prima. Well, DFIs play, and the private sector partners, they play a very important role in for the purpose of development, in this case, infrastructure development using PPPs. Political will plays a role in how these DFIs and private sector partners are received. And that depends on the terms and conditions of how the financing is structured. I believe that the Namibian government is not any different from the rest of the SSA governments, and thus require that these terms and conditions are really in the best interest of both parties. Government, however, is not just interested in financing from the DFIs, and it's rather interested in the full package, which includes valuable policy advice, technical assistance, facilities that support project development. I think quite a lot of these have already been alluded to by the previous speakers. Capacity development and knowledge that DFIs have. And therefore, the private sector must be prepared to play a role in project preparation. Well, just maybe to answer the question, with regards to whether we can do small PPPs, we have a threshold. For Namibia, we have a project has to be at least worth about 10 million Namibian dollars for it to qualify. And this is due to the long-term nature, in that there should be sufficient time for the private partner to recoup their investment. Projects that are of lower value can be done on using other procurement methods. So the small gardens, PPPs are essentially for infrastructure and the service that goes along with it. I believe that those ones can be done then on a traditional procurement. And also PPPs are not a quick fix, and they require long-term planning, because it's also a long-term thing. It's like meeting somebody on the street, and it's not like meeting somebody on the street today and tomorrow you are getting married. You have to really ensure that you are compatible with this person. So I am just wondering then, by shortening the process, what would the person posing the question suggest we skip? Because it's essential that all the process that is required in terms of doing a due diligence is performed. So do we skip the feasibility study, and to what extent, or what do we skip? However, the shortening can be in terms of, for example, in Namibia we have, and I believe in other jurisdictions as well, they have a request for qualification stage and a request for proposal. Perhaps that's where the process can be shortened by bundling the two. But then it also depends on the quantum of the project. If it's a massive project, you will have to do a request for qualification first before you go to request for proposal. However, if it's a project of low value, the two processes can be bundled into one. Yeah.
Thank you very much, Rauna. And I think you really emphasized the point that a PPP is different from public procurement. We just cannot compare the two. In the interest of time, I'm just going to ask Salim. There's a question that came in for you, and then I'll invite all the panelists to close. And it's about financing of climate resilient projects. Someone from Nigeria has asked how PPPs can help when it comes to funding climate resilient projects. I think there's an issue about governments not being able to fully support climate resilience, but how do PPPs then come in to address the question of climate resilience and climate change?
Firstly, I will try to respond to that. I think this is something that as ACF, because we are based on the continent, we are talking to a couple of experts and government around looking at climate risk, particularly for sectors that are important to national economies and for their ability to be able to resolve the impacts and the frequency of climate risk on key economic sectors, particularly agriculture remains an important area. And I would say that in the next year or so, you will hear a lot more of some of these programs. We have put a terminology on them, call them adaptation and resilient investment platforms. And so we are busy unpacking that. Just lastly, I want to say that I'm far more sanguine and philosophical about philanthropy on the continent. I think that the approach of philanthropy around the development agenda and unlocking what I would say new investment pathways is a very new journey. And Batil, in 2-3 years, your slides will be sort of old news, and hopefully there will be more examples of how it's being done. And I do think they already exist, and I think we should definitely have a special session on how philanthropy can play a bigger role in the space. And I think all the points you raised, I would not dispute, including ego issues, as you pointed out. They're not only relevant to philanthropy, by the way. You find them everywhere. They can be an obstacle for progress, actually, and development. But I think most importantly, just to say, you talk about collaboration and so on. I think our lesson is to create a very strong ecosystem around a particular anchor initiative and try to, in a sense, nudge collaboration without trying to force it. Because if people don't want to collaborate, at least they can invest in the ecosystem. And if it's going to support a large-scale initiative where there's an energy transition plan or rollout of 10 gigawatts of green hydrogen, I think that's all that matters. We can't always force philanthropists to collaborate, but we can encourage them to invest in a collaborative mode, if you want it, in a particular ecosystem and the success of that ecosystem. So thanks.
Thank you very much, Salim, and thank you to all the panelists. I'm going to ask us to just give our parting shots, and they can be really related to, what you're doing, what you think the different institutions that are represented should be doing before we quickly move on to the next session. For the questions that were asked that we could not answer, we have a full day of panels, and we hope that we'll be able to address them in the upcoming sessions. We'll start with you, Moshood, parting shots.
Thanks, Prima. I think, I was just not to take up too much time, just try to reemphasize that I think, we've talked about, the issues and the solutions here today. I think, very important is, the issue of funding. And I think as we've all heard on the call, it sort of touches on, what the government is able to chime in terms of, the preparing project, being able to have the resources to run tenders, right? What philanthropy and, grant funds can provide to help us sort of close the gap, and, what aspects can also be sort of procured using private sources that have a return requirement. So I think it's it's a multiple, it requires a concerted effort from all of the stakeholders to be able to, help us close this 2.5 billion funding gap. There is only so much Africa 50 can do and institutions that exist today. So I think it is one of the issues. So I think solutions in that regard are welcome. And then secondly, on the area of capacity development, I think, we need to start taking this more seriously. I think Africa has gotten to the point where now, we sort of have 33 countries with, PPP laws and a dedicated PPP unit. So I think there is more to be covered. That is about 60%. There is more to be covered. So I think the requisite capacity on the government side needs to be bolstered to be able to do these PPPs more efficiently. Perhaps it might answer the question around shortening the process, right? And I think on the private sector side as well, emphasis needs to be provided in terms of empowering, local African sponsors to be able to do, sort of implement projects and, use local capital to invest in projects. So I think I'll leave it there. This has been very helpful for me, and I hope everyone enjoyed it as much as I did. Thank you very much for having me. And
Thank you, Salim. Batil, parting shots.
Thank you very much. Well, first of all, thank you for, I think this is it's good when you leave a panel and it feels like to be continued conversation. You've just started to get into the part where it gets exciting. So I'm going to paraphrase. There's this quote that I like, and I think it's applicable to the 4 Ps, to PPPs with philanthropy. So it goes something like, PPPs are already here, but they're not evenly distributed. Normally it goes, the future is already here, but it's not evenly distributed. And I think this is what we're starting to see, especially on the continent, that the future of PPPs is here. But, we have the discrepancies between Francophone and Anglophone Africa, which are quite clear. Philanthropy is nowhere nearly as engaged domestically and cross-border in Francophone Africa. So I think there are frontiers that we need to explore here. I hope that we will not end up in a world where value for money becomes the opposite of leave no one behind. In other words, that where it seems to make sense and it's savvy and your dollar goes a very long way, you have to leave people behind so that you can achieve that value. So I'll leave you with that. This is for me that kind of embodies the paradox of development today. How can we leave no one behind, accompany a just in green transition, while trying to optimize some of these solutions. So with this very tall order, allow me to thank you again, and I would say to be continued.
Thank you very much, Batil. Indeed, to be continued. Rauna, parting shots.
Well, my parting shot is this. I would like to urge for the governments to be, governments must avoid being penny wise, pound foolish, and avoid cutting corners that could result in adverse results for value for money. And due to high debts levels and fiscal constraints that most governments in SSA face, they must build capacity, and start appreciating the efficiency of involving the private sector in PPPs, because a lone government cannot do. And having said that, also political championship is needed, and most of the time the politicians are not on this type of platforms where we speak. So those are my parting shots, and I just urge all the countries also to prepare bankable projects so that all these funds that are floating in the market can find an investment home. On that, I thank you and wish everybody a blessed day.
Thank you very much. Thank you very much, Rauna. WAPP should think of having one where we invite the politicians. Salim, final parting shots. Salim, you're muted.
I think Salim's connection he seems to be frozen, Prima.
Okay. Okay. Would really. All right. Salim, I think you've joined through another
Yes,
device.
it was one of the failures of PPPs in South Africa, power cuts. So my battery sort of packed in. Just to say, and I will be very short, that I do think that there's an important role for philanthropy. I do think there's a lot of hard work to be done with philanthropy to come more into the mainstream architecture of sort of the development agenda. And let's not just focus it and encumber it around PPPs, but a broader economic development agenda. And I think PPPs are part of that. And I do think that if we can find ways to coordinate through the country platform models that I see that has been germane in JETPs, we can actually create momentum behind many things that otherwise would not happen. And I really would encourage us to. And by the way, you know, we are not one of those philanthropies don't like collaborating. We actually love collaborating, and we see the necessity for it. And I think that becomes more visible when you talk about a larger scale investment trajectory. Do you have to collaborate? Thank you very much.
Thank you very much, and a very big thank you to all the panelists. Indeed, we will have another conversation. At this point, we are 7 minutes over, and so we will very quickly run to the next session that is being hosted and moderated by Johnson Kilangi. So thank you very much, keynote panelists, and over to you, Johnson, on addressing key challenges to financing of PPPs.
Thank you very much, Prima, for doing a fantastic job moderating that session. And thanks a lot to Rauna, Salim, Bafil, and Mushud for setting a tone for the conversation in our session. As Prima said, my name is Johnson Mowasi Kilangi. I'm a member of the steering committee and also a chair of the finance forum of the World Association of PPP professionals and units. It's a great pleasure to have all of you today, and I'll be moderating this session that tries to seek potential solutions that we can be able to deploy and apply so that we can be able to address the many challenges that our speakers in the previous session have been able to allude to. So what we're trying to do in this session is try and get from the speakers, the experiences from some of the projects that they handled, the countries that they've been involved in. What is it that we can be able to apply in our respective projects and countries? What are the potential solutions that could work in the African space? So as much as the previous team has tried or has done a good job to showcase some of the challenges, I would also want to hear from my speakers what they perceive as challenges to financing infrastructure PPP projects, but we'll try as much as possible to emphasize on solutions, what can be done going forward to make sure that our PPP projects work, they're successful, they're attracting sustainable of finance. So to unpack this issue, I'm hosting a team of experienced practitioners from Africa and all operating in Africa. And I'm going to give them time to be able to share with us. And I hope all of you might find this discussion very insightful. So to start us off, I'll be hosting Dr. Emmanuel Onwodi, who is the Director for Planning and Research at the Infrastructure Concession Regulatory Commission of Nigeria. ICRC is an agency responsible for regulating infrastructure concessions at the federal level in Nigeria. And then next, I'm joined by Ms. Audrey Mwala, who is the Managing Director of Sycamore Credit, a microfinance company based in Malawi. But before founding the company, Audrey served as an acting Chief Executive Officer of the Malawi Public-Private Partnership Commission of Malawi. I'm also joined by Maggie Lowe, who is the Chief Executive Officer of Store Infra and Energy, which is a long-term impact investor in large-scale infrastructure and energy projects in emerging and developing markets that is very keen on supporting the growth of sustainable and resilient economies. And also to proceed on with the discussion around philanthropic finance is Mr. Chris Woman, who is the co-founder and chief partnership and strategy officer at Connect Humanity. Connect Humanity is an organization dedicated to linking communities with a blend of knowledge and resources they need to achieve digital equity. So as you can see, we have a blend of practitioners from the private sector and also from the public sector. And I believe out of this, we'll be able to showcase quite a number of solutions that are available to us to apply to make our PPP projects successful. But just before we begin, allow me to share a bit of basic housekeeping guidelines for this session. For the next 50 minutes or so, actually Prima has eaten, I think 10 minutes of our session. So we are going to engage our speakers in the next 50 minutes or so. We'll try to get their feedback. And then thereafter, we'll try to dedicate about 10 minutes to answer to the questions that you are going to direct to the speakers. I understand that our chat box has a challenge, so I encourage you to direct your questions to our Q&A chat that is available on your screens. Hopefully, when we get time, we are going to also pick a few questions from the audience and try and see if our speakers will be able to respond to all your questions. But because of the limitations of time, I encourage all of you to engage in the Q&A box and also extend this conversation to our social media pages on LinkedIn and also on Twitter. So I'm going to begin the session, and I want to pose a question to my speakers, and I'm giving each speaker about 5 minutes to give me their responses. And what we want to do here is to understand from the experience of managing infrastructure PPP projects in Africa, what are the unique challenges that you or your projects face in attracting finance? I'll also want to hear what do you think are the possible solutions to address these challenges? But most importantly, what are you doing to address these challenges? And I'm going to start with you, Dr. Emmanuel, in the next 5 minutes or so. Let's hear of your experiences from Nigeria.
Yeah, thank you very much, Johnson. First of all, let me thank you for having me on this session. My name is Dr. Omode Emmanuel. I am the Director of Director of Planning and Research of the ICRC. Like you said, the ICRC is the government institution that is charged with the responsibility of ensuring that we attract the private capital into our infrastructure development, be it greenfield or brownfield infrastructure assets. I also want to thank the rest of the panelists. And indeed, I can see a very rich team, that will be discussing this the topic for today. Needless to say that we're at a time where we need to really sit down critically and address these issues. So the topic for discussion remains very key, and I'm happy that it's a subject of focus and seeing how experts across Africa have been able to, bring up solutions to manage our problems as fast as this is done. But I'll just try to look at some of these challenges as maybe looking at barriers, and then find out what remedies we can then put forward to making sure that we're able to manage these challenges as much as possible. So a lot has been said this morning, and I really emphasize that one of them is the inadequacy of properly prepared projects. From my experience, having worked on PPPs for over a decade now, realize that the problem really is not financing. The problem is the ability to, come up with viable projects. And I'm happy some of the speakers this morning did emphasize there are a lot of capital flying all around and looking for, viable projects to really settle it. So the responsibility lies on project developers and institutions, ministries, departments, and government agencies to then see how they are able to prepare projects, looking at cost of preparation along the line. First of all, do not even have what you call the project preparatory funds to develop this project. So that becomes a serious barrier in even getting past this stage. So from time to time, we find out that even in terms of creating, reviewing a value for money situation, you know, we find out that we have a deep problem that we really have to address. So all this put together makes it extremely difficult to come up with properly prepared infrastructure projects. And when you do not have properly prepared projects, you cannot answer the questions of viability. It means those projects are not going to be viable. It means that they will not be able to attract the needed funding or the needed capital to addressing those problems. So the remedy for that, for me, would be to try to reduce the risk and improve bankability of projects. You know, so once we get in and we're able to structure projects properly that will attract the needed financing, then we're on our way to solving that that problem. So I will imagine that one of the ways to address that will be to actually address the risk issues centered around our inability to structure properly prepared projects. So that would be for me number one, and I think that has also been emphasized in the by the earlier speakers. Another thing I see coming up is the lack of collaboration between technical experts and, of course, the financing community. Imagine that a program like this, for instance, where we're discussing financing, you imagine that you probably will not see the community of, for instance, engineers attending. So you are discussing about financing and addressing financial issues, but other sectors like engineers, like other firms, they hardly attend programs like this. So there is that synergy that is not there. So you find out that by the time you are not able to collaborate adequately, people do not understand the language of the lenders. They do not understand what the lenders will want. So as they develop infrastructure projects, it becomes very difficult that, we're able to collaborate. So there's a breakdown of communication, and to a very large extent, there is also therefore the problem where we are not able to then adequately understand ourselves. So first of all, there's a breakdown on communication. There's a problem with collaborations. So we expect that if we're able to address these issues, for instance, getting the engineers, for instance, to collaborate with the financing community and creating that common understanding of what PPPs are all about and how we can address, for instance, the financing issues. So once we're able to, as a remedy, create that strong communication line, it then means that from the onset, at the moment we begin to initiate our PPP transactions, all the stakeholders that are necessary to support and make sure we arrive at our financial close, as we always say, are carried along and brought on board, to a very large extent. So that would be for me the second point. The third one, if you allow me, is to hammer this point
30
about.
Seconds, please.
Sorry?
30 seconds, please.
30 seconds. Okay, so I'll quickly run through. I also did look at the issue of government continuity and the sanctity of our laws, with that in the past, and this had made it difficult and posed serious barriers to being able to finance infrastructure projects, especially where a previous government does not respect the decisions taken a new government does not respect the decisions taken by the previous government. So there's no sanctity of laws, and as a matter of fact, of course, because of the poor legal system, there's no continuity in government. We expect that for PPPs that are long-term in nature, there should be a continuous in place that will ensure that policies and decisions made are followed all through. The fourth one also for me will be the overpricing of risk.
Sorry, Dr. Emmanuel, I might have to come back to you because of the interest of time. I'll have to jump over to Audrey. But just to emphasize the point of bankability that you've raised, I think we've discussed about this for decades now. And it's clear that perhaps it's time that the public sector needs to pass the baton to the private sector so that they can be able to originate better structured projects. But that is connected to your second solution, the aspect of us working in silos. How is it possible that we can bring these key stakeholders together so that the private sector understands what the public sector is doing, and also the public sector understands the requirements of the private sector? I think that is a serious conversation that we need. And as Prima said before, perhaps we need to bring the government in these conversations so that we can have this candid conversation. I'll jump over to Audrey Mwala from Malawi. Audrey, if you can hear me, please, let's hear your thoughts. What do you think are the solutions that we can be able to apply in our projects?
Thank you very much. I can hear you, and please confirm. Can you hear me?
Yes, I can. Please proceed, Audrey.
All right. So my thoughts from Malawi with regard to the challenges that have been stipulated, and also other challenges that I am aware of, which I would add to do with understanding of the PPP concept itself by the masses, as well as those in decision-making power, to really understand how it works. It's also another challenge that poses a challenge with attracting investments, with attracting the finances for the project. What I've seen is that people don't understand that a PPP is simply an alternative means of procuring infrastructure. So as a result of that lack of understanding, they now begin to look at private party negatively. They don't understand that it is the same arm of government that is actually procuring. It's just that instead of investing the money in the infrastructure today straight from government, it is actually using private sector to invest so that the government can make the payment along the way in bits and pieces going into the future. So there is a very deep understanding that the public fails to grasp, and unfortunately, even those in decision-making power, when it comes to certain decisions to be made at cabinet level or at parliament. So that misunderstanding makes it difficult for them to understand the true cost of a PPP and also the concessions that they need to make, understanding that it is actually the very same government that is doing it. So there are quite a number of challenges, but maybe let me just add one that I've said and then move to the solutions. The solutions that I see, in my opinion, and especially looking at what we have done in Malawi, and we have progressed reasonably well in terms of developing infrastructure using PPPs in various sectors. And some of the things that were done in the country were, first of all, the enabling environment. So there was an act that was enacted in 2011 that allowed private sector to come and invest as PPPs. And through the implementations, a number of lessons were learned, and we now had to take a pause and relook at how we can address some of the challenges that we made along the way. And as such, we now amended the act, and we have a new act, PPP 2022, that now addresses some of the challenges that we had, some of which were to do with infrastructure development using unsolicited bids, and how you can deal with direct negotiations, how you can allow the organization to raise money so that the organization can run smoothly to charge for certain services that it was providing. So the law itself provided confidence to investors, and indeed some transactions have been done because of that. In addition to that, there's also something that I found to be a bit unique and interesting in the Malawi side in addressing the aspect of financing, and this is to do with how we structured the PPP implementation. There was a separate entity that was established called the Public-Private Partnership Commission. So it was a legal entity enacted by Parliament, and is separately located actually away from Ministry of Finance. It was away from the Capitol Hill where the government offices are. And it is run by a body where there are some members that are independent board members where reports will be given to. So that created an interesting development with regard to autonomy to be able to make objective decisions based on business case analysis, but it also helped to create what I think is the best, which is capacity building, because the people that were in the PPP Commission have been there for a long time. They've been sent for training, and actually I am one of them that benefited from there, where I joined the PPP as somebody who doesn't have any qualification of PPPs, but then I was able to get to a level where I was triple certified as a PPP expert through the capacity building programs that were there. So it helped to ring-fence capacity in the organization by putting it as a separate unit. This is different from having the unit in the Ministry of Finance, where people are moved up and down every time. And not only that, they are also, even though they are physically there, they are also given other assignments to go to that now compromises their time to focus on the PPP implementation. So that's something that I think worked well. And I would think that if people want to borrow a leaf from Malawi, it would be something worth doing, because I myself have worked in it and I've seen that it is a great thing. And it also helps a lot when it comes to issues of accountability, where you know that when you have some international institutions that want to support the PPP program, it is housed in a specific unit other than just thrown anywhere in various government units. So that helped a lot. In addition to that, in the PPP, we also came up with an aspect of developing the PPP pipeline. So we worked with the government central planning unit called the EP&D that looks at all the ministries to find out what they are looking for, to find out what they need in terms of infrastructure development. So by doing that, they provided the projects, various projects which they will be looking for in that particular year, and we put everything together as a pipeline. So that also creates some confidence to the investors, because they can see a pipeline and also they can plan ahead to know what's coming next through that compendium of various projects. So that is something that I think it helped. In addition, we also noted that I think it was already said in the previous session that the challenge with PPPs is to do with the lack of preparedness. So we noted as well that if we have a project and it's not ready, there will be nobody who will be attracted. So we convinced our government to set up a project development fund. So they actually funded it from their own internal resources as government. And that funding allowed us to start tapping into that money and now start carrying out feasibility studies. And interestingly, I will also add that there was also something that we did, which was a little bit extraordinary, where before the coming in of the project development fund, we had a lot of projects that needed to be prepared, but we did not have consultants because we did not have the funding to pay the consultants. So we also, because of the capacity building that we did along the way, where we were trained, we were able to form a consulting team within the PPP unit. So we were a team of myself as a financial expert, and then we had a lawyer and then an engineer, and we formed a consulting team together with various ministries to now carry out the feasibility study ourselves. Actually, there are 2 projects where we have PPP concessions that are running, where the feasibility studies were just done by ourselves because we didn't have money to hire consultants. But then later on, we also noted that it was overwhelming. So it's something that I would not really advise that we can have it as a normal model, because carrying out a feasibility study takes a lot of time. So it was also too much that we didn't have much time to now manage other activities. So the best really is to maybe balance, but mostly to use consultants and to have funding. So for us, we have that funding now that came from government that is now in the PPP unit, and they are currently using it for project development. That funding.
Thank you, Audrey. Sorry, I might have to cut you short because of the interest of time. I'll definitely come back to you. You have quite interesting solutions there, which I think we need to consider in the African space. Unfortunately, Marie has not joined us yet. I think she's having some hitches. We hope that she'll connect with us as we proceed. So I'll jump over to Chris Woman. Chris, we've had interesting conversations before on philanthropic finance, by Bafil. And we also want to hear from you, what are your experiences? What are your thoughts? Do you think philanthropic financing is a potential solution that could be applied in the African space? The next 5 minutes, Chris, the floor is yours.
Thank you, Johnson. And I certainly hope it's an option. Otherwise, I'm going to have to find a new job. But it's a pleasure to be here. And as I noted when we first met, I spent my childhood in Botswana and get back whenever I can. It's been a while, thanks to COVID and now 1.5-year-old baby, but soon, I hope. So thank you, Dr. Onwodi and Audrey, for saying everything I was going to say. This can be quite quick, actually. To the question about sort of, in our experience, the challenges to PPPs around digitalization, really 2 factors when we're looking at digital equity investments. And by that, I mean investments into digital infrastructure, networks, device access, ensuring that people have the tools to actually use the internet should they get it, and then in the training and skills to then sort of fully utilize digital, particularly for the things they care about on their terms, not just sort of a pre-baked solution about things we might think are useful. So connectivity, tools, skills, those are the things we invest in when I talk about digital equity. So the 2 things that we face are really barriers around understanding and risk. When I look at the global finance community, there is a lot of privilege and a lack of understanding that this is still a problem and that the current approaches really aren't working. A lot of the investors that we deal with, from foundations to big funding sort of institutions, find it hard to believe that half of the world still lacks the internet because they've been online for a very long time. And they find it hard to believe sort of the critical nature of this challenge. They find it hard to believe that there are options and that throwing money at traditional models has not and will not work due to a misalignment of telecom corporation business models and market realities. We have to have PPPs to solve for digital divides and digital inequities. Second, risk, a belief that, and I think this has been true with other infrastructure and other, quote, sort of base of pyramid approaches, that public-private partnerships around digitalization are inherently risky. They're not. There are clear business models to recoup capital. It is not and should not be at venture capital rates of return, but that does not mean that these are not profitable ventures. Even if they were unprofitable, we would not stop water projects because they're too risky. People need water, so we figure it out. People need digital access in a digitalizing world. We need to step in and figure it out. A couple of more points, possible solutions. There's certainly commitments from philanthropy and governments to work through those options and solutions to building digital public goods, an evolution of regulations to allow space for alternative models, and insistence on basics in the policy space, like dig once policies that require contractors building public infrastructure, roads or electric grids, to lay conduit through which fiber can be extended later, whether they're ready or not. What are we doing about it? Trying to demonstrate the way, frankly. We're using philanthropy to do research, invest in planning processes with communities, something Dr. Onwodi and Audrey called out in terms of properly preparing projects, making sure they're investment ready. Essentially, we're demonstrating these models in practice and using that to teach philanthropy and banks and communities what their options are through actually doing the work in a way that isn't risky to them. Philanthropy is picking up the tab. They're not. Well, at the same time, working on really massive communications projects to help determine and demonstrate demand. Recently, we had 7,500 civil society organizations around the world, including more than 1,000 across Africa, respond to a survey about barriers to digital inclusion from a community level up. Very last thing I would say, we attempt to share those learnings. We're building an education arm to work on very tactically training. So some of the points that Audrey raised on designing and funding digital infrastructure. But in the meantime, yeah, we do try to publish if you need some reading that may or may not put you to sleep. If you look at our website, connecthumanity.fund, there's a research and publication section. So trying to de-risk, increase that understanding, and share everything we learn.
Thank you, Chris. Again, I want to emphasize what the previous team had alluded to. We are acting in silos. Government does not know what some of these philanthropic organizations are doing and how you can be able to work together to mobilize and catalyze sustainable financing for the project. So I think there's quite a lot of heavy lifting that needs to be done there so that we can start seeing a coherent conversation happening that moves projects, especially to the underserved communities in the African space. So I'm told Marie has not joined yet, so I'm going to jump over to the next question. But before I pose the question to Dr. Emmanuel, I'll want to echo the sentiments that were made by our president, Ziad, at the opening of this session, that Africa's infrastructure has to be developed by Africans. So it's very important for us to understand how do we get involved in this process. I think it's in the public knowledge now that we've been talking about how do we get our pension funds into infrastructure projects. As much as we see the potential of those funds, accelerating the development of infrastructure, it is not happening. And even if there are some flows into the space, it is not sufficient. Just to give you a practical example, having a conversation with an investment wing of a savings and credit society in Kenya that has huge savings. And I asked them, why can't you invest in these infrastructure projects, which will give you a relatively higher return than you investing in buying land and houses in the remotest of places, just because you want that security? And the guy said, we don't understand how infrastructure works. So clearly, there's a lot of work that needs to be done if at all we need to see these flows moving into the infrastructure space. And that is the question I want to pose to Dr. Emmanuel. What is the experience in Nigeria? And as the ICRC, what are you doing so that you can be able to attract more of domestic capital? What are you doing, or what should we do to unlock domestic financing in these projects?
So thank you very much, Johnson Kilangi, for that question. Indeed, as a Nigerian and being a staff of ICRC, a lot has been done over the years. Part of the clear things we have done is to encourage the government to set up PPP units across ministries, departments, and agencies to then support government efforts at building capacity amongst PPP officers. I personally have trained over, and still counting, over 3,000 top level, middle level, low level staff in PPPs across the the stages of PPP. So that alone has sort of brought some sort of confidence in officers who handle PPP transactions, such that they're able to understand some of the stages in the PPP world. ICRC has also, in the time, some years back, we've conducted a research. We've tried to deepen the capital markets by introducing alternative financing tools such as the Islamic bonds, which you call the Sukuk funds. So in 2011, we did a study, and the report from that study clearly indicated that alternative financing could be another source of financing of infrastructure assets like the Sukuk. And as I speak to you, some of the federal roads have been rehabilitated through the issuance of Sukuk bonds, and then some subnationals too, like the state governments, have also introduced Sukuk in their education and other sectors to developing the infrastructure asset. These are clear support that the ICRC tried to promote to encourage the development of PPPs and address financial or break the barriers in terms of creating the necessary finances. So that also has helped us to deepen our capital markets. As you rightly know, the PPPs are, expect long-term capital funds. So what we have done is to deepen the capital market with long-term financial instruments that these projects can then speak to, and then be able to attract those long-term funds to support their efforts. So ICRC has done that to apart from building capacity and creating the necessary alternative financing sources. We've also tried, apart from also I've talked about the capacity building efforts that we have tried to do, training officers in negotiation skills, training officers in financial modeling. I'm a financial person myself, taking people through financial models, and also being a risk person myself. Also, I've been involved in, having sessions on risk management, because at the end of the day, PPP is about financing and risk, how you're able to allocate risk appropriately and mitigate and identify mitigants that will enable you address those issues that you face along your PPP processes. So we've tried to encourage MDAs to understand their risk register, their risk book throughout the entire processes of their PPPs, and also be able to be confident as they address PPP transactions. One other thing that we have also done is to simplify our PPP process. Before now, we had a long, process where we had to, go through different stages, and it takes forever to come up with a PPP transaction. Now we have just a two-stage process. So the moment the PPP project, so we have two routes. One is a solicited one, and the other one is the unsolicited one, which is what you generally call the privately initiated infrastructure proposals, which is called unsolicited proposals in certain climes. So what we then do is, at the moment the project is issued with a business case, and we certify the business case to say that this project is ready to go, it is economically and financially viable, then we launch a two-stage process: the RFQ, which is the request for qualification, and then the RFP. The RFQ enables us to pre-qualify bidders who have the right skill sets and the right capability to, and experience and all that. And then the other guys will then be issued with an RFP. So the RFP is the second stage, which is a request for proposal, asking them to submit their financial and technical proposal. So it's just a two-stage process. We evaluate those RFPs, we then rank them, and then we have the preferred and the reserve bidders, and then quickly go into negotiations. And as soon as we wrap up with negotiations, we do our due diligence, and then the contractual concession agreements, etc. So that's how we've been able to ensure that within 6 months, some projects have been well done. Gone through the process. Well, between 6 to 24 months, we've been able to manage certain complex PPP projects, such that they go through all the tick boxes, like was mentioned earlier. And the other thing we've also done is that we carry along the lenders from the beginning, try to let them understand how these transactions are going. But most of all, we've also tried to ensure a transparent process, because we understand that lenders will come and also do their due diligence on the entire process, and to be sure that these transactions have happened, transparently and with openness and competition as much as possible, because we believe that it is competition that drives value for money, which is the reason why government decides to bring in the private sector into that that PPP space. So we've tried to create the understanding of PPP transactions so that parties understand the kind of transactions they are getting into right from the beginning, and it makes it easy for parties to see it as a win-win situation. It is not a winner takes it all, because at the end of the day, we want to be able to bank every transaction that we get involved with. I was just sharing with some of my friends, and including
Thank you, Dr.
Zayed at the PPP workshop.
Sorry, I hope I don't pass to be biased. I might have to cut you short again. Sorry, Dr. Emmanuel.
Okay.
Quite
okay, thank you very much.
views there. Of course, the importance of building capacity, and maybe I'll come back to you. What kind of capacity building are we talking about? And don't you think that it's also important for the private sector also to be empowered so that they understand how they can package the financing solutions to work for the projects that the government is putting together to deliver jointly with the private sector? So quite interesting there. I'll definitely come back to you in the next round of questions. So allow me to jump over to Audrey Mwala from Mwala. We definitely know that most of these PPP projects, to some great extent, will be financed by the private sector through the project finance model, which perhaps is not very clear to many players in the sector. So for the projects and the stakeholders to optimize returns through this model, it's important that we structure the repayment to be relatively longer so that we're able to benefit from the opportunities arising from that model. But this is not what is happening in Africa. We have players in the finance market that are very resistant towards lending to infrastructure. And even those who are lending to the infrastructure, they are very conservative in terms of the tenure they can allow to lend to these projects. So what do you think can be done? What is your experience in Malawi, and what should other countries that are connected in this call be able to take home and apply in their projects?
Yeah, it's true that it's indeed a challenge. I remember we had to go through different financial institutions to find out if they can lend, and all of them answered us that the longest they can lend us would lend money to the PPP project would be 5 years. And mostly this is coming from regulation, the prudential regulations that are there from the central banks. So they put a limit both in terms of the duration risk as well as the concentration risk. So that creates a challenge in terms of them being able to lend. So what that means is that maybe we are looking at a wrong kind of financing, because if we are looking at commercial banking, then we are looking at short-term financing versus a long-term project, which is not matching. So there is need to match the kind of financing where we are looking at development financing that would be looked at patient capital that would be there for a long time compared to this short-term financing. We recently had a project in Malawi where we are working on developing 350 megawatts of power called the Mpatamanga project. And in that project, obviously, we need a lot of resources. And we resolved that by finding mechanisms to de-risk the project while looking at the long-term solution of developing our own infrastructure financing institution that will bring together resources to be made available for long-term projects. So with regard to Mpatamanga, what we did was to work with World Bank to help us to get resources to be put as part of equity by one of our power generation companies to go in the project. So it sort of de-risks the project by bringing cheaper financing, but also just showing that government has got skin in the game. In addition, we also worked with IFC, who also took equity in the project. And that also was part of a de-risking. And then that allowed other part of the equity to be made available to private sector, and they found it attractive for them to invest. We looked at that as something that could help to, otherwise it wasn't going to work using the local financing. But then over and above that, now we are going to use other local funding, such as pension funds that we mentioned earlier, as well as the commercial banks, to fund some short-term needs of the project itself. So basically, that's what we have done. We have also used the philanthropy type of financing in a project in the tourism sector, where the investors were really bringing in money that was not really for them to make a profit, but simply to conserve the environment. So we have benefited from that already in one of our projects. And recently, we've also done a PPP project for student accommodation. And one of the ways we have also managed was to use not the commercial banks, but we use the pension funds. So since pension funds are relatively long-term, the pension company was able to put in part of the equity using the pension funds, and that also de-risked the project from FX risk as well. Of course, there is an international foreign currency investment that also topped up, but then the starting point was the local one. So that helped as well to get the project started. So maybe that's what I can say before you tell me to stop, because you are telling us to stop.
Sorry, Audrey, actually I'm trying to manage time. And I find those very interesting solutions there, and perhaps this is a discussion that we need to continue on with.
But maybe I can just add one. I can just add one on the tax. We also, like on the projects that we are doing, we also have a special tax regime to incentivize the project, to just make sure that the project is cheaper and affordable. Because if you look at affordability parts, sometimes it becomes a challenge because of the tax element on it. So that was also another aspect that I can add. And maybe one more aspect I can add in terms of the general attraction of private investment was on the structuring of the remuneration to private sector. Because in most of our projects, we've used availability pay, where the investor simply provides the infrastructure, the beds, and then government pays for that.
Thank you, Audrey. We'll definitely get back to you to learn more about some of these solutions. And this is one of the ways that we can be able to add value to the members of the World Association of PPP units and professionals. And thank you very much, Audrey. And allow me to jump over to Chris. Chris, philanthropic organizations like yours, Connect Humanity, can actually act as catalyst in attracting sustainable finance, especially for socially impactful projects. As you plan to enter the African market, can you let us know how your solution can help in attracting financing for projects in this region?
Sure thing. So I think reiterating a lot of things that have been said by the other panelists and some of the points that I opened with in terms of understanding and risk. So to the point of understanding, philanthropy, and we are a philanthropy ourselves. We operate both a foundation that does grants and technical assistance and a loan fund that does loan investments. So we're a blend of finance, a blended finance organization. So when I say philanthropy, I include ourselves in that, but also certainly an encouragement to other philanthropies to take note of some of their options. Understanding, as I was speaking about earlier, philanthropy can support research, advocacy, and models that certainly help all stakeholders understand their options. We can also, as philanthropy, demonstrate analogous models. A lot of these investment models have been deployed before. We've done these things, both as philanthropy, as communities, and I say we in a very large sense here. People have learned these lessons in Africa as they have everywhere in the world. And it doesn't help us to not talk about analogous models and understand that we've walked these paths. Many of these are not new ideas. They're not unknowable or unknown. So helping people de-risk their own understanding by reconnecting with the fact that they have tried these in healthcare, in roads, in water systems, et cetera. The second thing in terms of understanding is taking on risk directly. We've talked a lot about risk today. Philanthropy has an incredible role to play in de-risking. Philanthropy often likes to call itself the most risk-tolerant capital that is out there. That is true technically, though I often don't see it in practice. But philanthropy certainly has the opportunity to use its resources to do the technical business, financial plans that are needed to diligence and de-risk follow-on investments, the sort of proper preparation that's been spoken of. Philanthropy can afford to invest in these plans and give us the roadmaps we need in ways that other entities cannot. You know, it's harder for governments to do that. It's very hard for businesses to make those kinds of investments if they don't see a direct line of return. Philanthropy can, to a question that came up from Victor in chat, also really help engage communities in these processes to ensure that communities understand, want, and value the PPPs and investments we've been talking about. This is critical in our work, which is ultimately sustained to a large extent by paying customers. That is more or less true depending on what exactly you're investing in. For us, this manifests as our interest in matching the technical assistance that communities need to deliver proper and, most importantly, finance-ready plans. This come up earlier, you know, as a philanthropy, we sit between communities and lenders and ensure that all sides are getting what they actually need on terms that are suited to sustainable development. Again, Dr. Onwodi and Audrey have said it. Really, you can just cut any questions to me, ask them, they'll give you the right answers. And then sort of secondly, on the de-risking side, sort of the last point I would, or the second point I would make is that philanthropy can de-risk a lot financially. This looks like loan guarantees, loan loss reserves, and other first loss lending practices that reduce risk to further investors. So invest in the plan and then invest in de-risking the finance that is the follow-on capital to that plan. We can also follow models at the intersection of philanthropy and development finance, like enterprise and green bank models that built unsecured loan funds to spur a part of the economy that we didn't have. If you're unfamiliar with the green banks or the enterprise funds that were backed primarily initially by philanthropy and then leveraging a lot of government money to build an entire segment of an economy with unsecured loan funds, I highly recommend those models. We're working on one sort of a global digital equity fund for last mile connectivity providers because it is more risky than most people are willing to tolerate in their investment, but it also has the potential to return funding, and we need it. We need it critically. So who's going to take that bet? Let's have philanthropy take the first loss. Government can take the second if there is going to be one. And then this opens up for much larger investments from pension funds and capital markets, places where you actually have enough money to do the hundreds of billions of dollars of work needed to close the digital divide. So again, philanthropy can deliver that plan, the community necessary to develop the plan, and the investments in de-risking the necessary cash to come along afterwards. Philanthropy doesn't have enough money to do it on its own, but it can certainly start paving the way for others.
Thank you, Chris. Clearly, I think you're going to be more effective, in meeting the needs if you're able to work closely with the different stakeholders in the infrastructure space. I think Bethil had indicated that, if you're a philanthropic organization 6,000 kilometers away, it's difficult for you to understand what a small community in Turkana, for example, in Kenya needs and how you can package a solution to be able to meet that need. So again, the need to work closely with local actors, with government to understand what are the strategic goals of the country, what are the needs of the people, how best can we meet this need. So it's definitely a conversation we want to continue on with, and again, we need to get solutions that work for Africa. So Unfortunately, Marais has not joined us yet, so I'll move on to the next question that I had for the speakers. And this is just a recap of the discussions that we've had around the need for us to better prepare projects, projects that are bankable, projects that are able to attract financing. I think it's clear that if we don't have those projects in place, then there is no possibility of us unlocking that critical domestic finance. If you look at most of the project pipelines for units across Africa, you'll realize most of the projects are still at commercial stage and they hardly move to the financial closure. So clearly there is a problem there, and it's something that we need to address. But again, Africa is in this catch-22 position. We do not have the funds to do studies, yet we need good projects to attract financing. And I think I like what ICRC is doing in Nigeria, and of course, Malawi, the Commission, in trying to build capacity so that we can, at some point or to certain projects, prepare these projects better internally when there is no access to funds to prepare better projects. So just to get opinions from the team, what do you think should be the way forward? What can we do? We have projects, we have needs that we need to meet. We don't have the funds to be able to better prepare these projects. What should be the way forward? And I'll start with you, Dr. Emmanuel, and then I'll move on to Audrey, and then lastly, I'll move on to you, Chris.
So thank you so much again. Once again, I think the issues are getting very clear as we discuss them and as we arrive at some sort of solution that is a made in Africa solution, if you want to put it that way. So I think the first thing to note is that we need to therefore encourage, make efforts to understand risks in projects. That's project risk. Because if we understand the project risk, financiers, for instance, themselves will not overprice the risk. Because sometimes the financiers, when they come into a project, they basically just overprice the risk in those projects and that kills projects from at the beginning. And that is because some of them do not really understand the risk in certain projects. Some projects, to my mind, based on my experiences, I found that, look, they've really overpriced it. Sometimes they're asking for sovereign guarantees when really the solution to that project is not. Probably they just needed a letter of credit or just need a support letter or some sort of guarantee or waivers or some level of incentives. And then they just go and say, look, we want the sovereign guarantee. In our situation, sometimes in the past, when we're dealing with railway projects, we find out that most of the projects that we're dealing with on railway, the Chinese wanted sovereign guarantee on almost all the rail projects. And in addition to that, the seaport projects, which are supposed to be economically viable projects, investors are asking for sovereign guarantee. So I'm asking, if you're asking for sovereign guarantee for social infrastructure projects, and you're also asking for sovereign guarantees for economic projects, and why are we having the private sector in the room? So they're supposed to take the risk that they are better able to manage. And to a very large extent, a good understanding of project risk will ensure that financiers do not kill the project by unnecessarily overpricing the risk. So the first thing is for us to create that forum where we can speak to lenders, where we can bring lenders into the room early in the project development stage so that they understand the real risk. The other thing to say is that government has to respect the laws. If they fail to respect the laws and the sanctity of laws, these are, for me, what I call confidence killers, because naturally it kills the confidence that people have in transactions. Investors run away, knowing fully well that when a new government comes in, they will not respect the concession agreements entered into. And that's one other area that the ICRC Act of 2005, you can check that out on the website. Clearly Section 11 says that you cannot terminate or cancel or alter any contract, any concession agreement entered into under the Act. So that sort of gives confidence to investors who want to come into infrastructure space. The two other things to say is that we need to continuously build capacity. We cannot run away from that. By building the capacity, we have the right mindset of individuals who are able to prepare properly prepared projects, viable projects that financiers can then look at and be able to lend to. The final thing to say also is that we need to look at the, so I'm looking at CapEx, for instance. So sometimes I'm talking in terms of spreading the CapEx now. So if you have a project where you're looking at all the CapEx coming in, for instance, in year 0, it becomes difficult for lenders to, mobilize funding. So if we have projects such that we can structure it in such a way that the CapEx are drawn at different stages, essentially not when these projects have not started realizing cash flows, but if you structure production in such a way that the early drawdowns are not too significant, that way you free up your cash flows. The lenders are happy to give more lending when they can see some cash flow streams coming in. That way those transactions are able to secure financing as quickly as possible. So I believe some of these remedies, like the panel have said and some of the panelists have said, are things that we can look at. Alternative financing like Sukuk and other forms of funds, setting up a good framework for assessing pension funds and other kinds of long-term financial instruments will also be good. And then, of course, turning to Chris Woman to see how we can explore their philanthropic funding pot. I'm coming after him after this program to see how we can get some funding ourselves, because from the ICRC's point of view, we are reviewing our research policies to see how we can get some research, deeper research to look at the problems and see how we can provide solutions. So we need some funding to do some research. And if you have one, please let me know. We can start later this afternoon with the research. On that note, I think I'll submit Kilange and thank you for the opportunities.
Thank you, Dr. Emmanuel. Please stick in the conversation. There's quite a lot, and I'll urge the speakers to start responding to some of the questions that are already in our Q&A, and some already posted in the chat box available to the speakers, so that we can be able to save time and try as much as possible to respond to possibly all the questions there. So thank you very much, Dr. Emmanuel. I'll move to Audrey Mwala. Please, in the next 3 minutes. I know I'm mean with time, but let's hear from you. What do you think should be done going forward with regards to this area? Audrey, you're on mute.
Apologies. So when there is no resources to do the feasibility studies, to do the PPPs, some of the ways that one can adopt, and some of the ways that we ourselves adopted when I was working for the PPP, were to use our own internal resources, as I talked about. But another way would also be to find ways of raising money. So, for example, we had other concessions that were already running. So the concession fees that was coming there was also being used to fund the organization, and in such a way that if it's funding the PPP Commission, then we now had the operational needs and then have space to now focus on carrying out the feasibility studies. The other one was also to get money from 2 different sources. The first one, the contracting authorities, the various government ministries, when they contract the PPPC, there is a fee which they are supposed to pay for the PPPC providing the services. And in addition, at the investment level, when the investor has come, there is also a success fee, a certain fee which goes to the PPPC as an entry fee. So that also goes into the pool of funds that can be used for further project development. In addition to that, we also looked at the study tours as one of the areas for helping project preparation if you don't have capacity, because sometimes it's a helpful, instead of reinventing the wheel, to just go across the neighbor to find out if they've done the similar project, how they did it, what were their challenges, how they structured it. So that's also something that can be quicker as you're making your decisions and as you're preparing your projects. The other one has also been to go around and look for various donors to find out if they can support the PPP, even though they cannot give resources, but some of them have got experts which they can tap into and then provide those experts in the organization as full-time employees funded by them or just for a specific projects. We also had tapped into a certain facility which is just a pool of lawyers, legal experts that are always available to assist. When we were doing our PPP review, we tapped into that as well. So that helped as well in terms of project preparation to just use those. So the other one, which is a little bit challenging, but is something that can also be used, where you ask the private party themselves, especially if it's an unsolicited bid, you ask them to carry out the feasibility study, and then you just check on its viability and then maybe get a second opinion. That can help, that at least some progress should be made. Yeah, but government fund is the key that I mentioned, that is something that was not there for a while, but I remember when I was acting CEO, I pushed for it, and then we had that fund where government now starts budgeting. Every time when it is coming to its annual budget, there will be that resource put aside for project development. And now we have donors that are coming to top up. Those are some of the interventions that I would talk about if you don't have resources.
Thank you very much, Audrey. Clearly, Dr. Emmanuel, you need to speak to Audrey immediately after this session to see what they have done and what has worked in Malawi, so that we can apply it in Nigeria. I'll quickly move on to Chris. We have quite limited time, maybe in the next 2 minutes. Please, let's hear your thoughts.
Sure, easy to keep it brief. I think in addition to Audrey's point about funders having latent resources, one thing to think about there is asking funders for introductions. If they're good people, they will introduce you to other funders who also care about these issues. Funder networks are a great thing to ask funders for. If they cannot give you money, it's usually not because they don't want to, but they just don't have the funding available at that particular time. Fine, ask them if they have any friends who do. If you're not doing that, I recommend it. It's how I raise all my money. And then the other thing I would say is, in addition to all of the excellent points that have been made, I would strongly encourage people, sort of to the point that came up from Victor about working with communities, and Johnson, to your point about ensuring that these solutions are locally responsible, respected, wanted, work with and through civil society. I think, most of the PPPs that we're talking about are the things that we have in mind when we think about PPPs. I would be surprised if they didn't tie back in some way to the kinds of rights that most of our governments have signed up for. In the case of the work that I do around digital equity, governments who are a part of the United Nations have agreed that access to the internet is a right. They have signed up for the SDGs. SDG 9C is about universal access. We have agreed that these things are important and that they are needed and that sometimes they're actually fundamental human rights. Governments have to be held accountable to keeping these things on the agenda and making sure that they get worked on, no matter how hard they are. You get there through civil society most of the time. You get there through partnerships with civil society who stands up and advocates for rights, because that's what civil society does. All of the rights that we tend to take for granted generally have a history of somebody in civil society demanding that they came true. So I think it's just something that the civil society and community points are worth keeping in mind. There are friends, there are advocates. As governments come and go, to Dr. Onwodi's point, civil society does not. Communities do not. They are there. Make sure they understand and appreciate this so that they fight for it with us for the long run.
Thank you, Chris. As short as always. Unfortunately, we're out of time, but Prima had eaten 10 minutes of our time. So I hope the management will be kind enough to allow us to eat a few minutes, beyond our time. And I'm going to use maybe the next 2 minutes to get feedback from Dr. Onodi. There's a question addressed to you. Please explain to us what Nigeria is doing to deal with the lack of legal environment for PPP projects, e.g. cannot issue any form of guarantee to debt providers, which is a fairly standard issue as security for debt providers in other sovereign countries. I think this is not unique to Nigeria alone. Many countries in Africa are facing this challenge. So perhaps just to hear from you, Dr. Emmanuel, what are you doing? You just told us that you're trying to do things right in Nigeria. Let's hear what you're doing to address this. Dr. Emmanuel? I think Dr. Emmanuel has a challenge with his internet connection, and so is Audrey. Audrey, are you in a position to respond, perhaps from Malawi's perspective?
I think I also had an internet fluctuation. Can I just ask you to just repeat the question?
So this was a question that was addressed to Dr. Emmanuel on the issue of guarantees and the resistance of the government to offer sovereign guarantees. Okay. I think it's a challenge we have in most countries in Africa. Let's hear from Malawi. What are you doing to address this?
No, certainly it is a challenge, and we do face it here as well. But I think there are two sides of it. The first side is for government to, first of all, understand that when we are talking about a PPP, we are simply talking about the very same government procuring the investment, but then using private sector. So what that means is that government has to understand that if it had to do that infrastructure itself, was it going to provide in one way or another that kind of guarantee to the provider of infrastructure? So that's one aspect. So that understanding is important. But secondly, the other aspect is the importance of now having very experienced PPP experts on the ground to be able to analyze the request of the investor to ensure that they are not being taken advantage of. Because you also don't want to just sell the country to commitments that are not right and are not sustainable. So it's a question of balancing. So the reality is that every government is going to say no to a guarantee, but then it's not just a question of just saying no. It has to be, the no has to come because there is a real reason that is behind it. But at the same time, you also have to understand that it's government that should have provided that infrastructure in the first place. So I think there was a question, a comment earlier on where somebody said people think private sector is more expensive than government, but it's because we are not really costing everything. That's why when the government has done something, it starts collapsing within a short time. Nobody's there to maintain it. People don't pay. So if we put all those and we have our public sector comparator and we are able to compare with private sector bid, and then we are looking at the shadow bid and see that there is value for money, there is no harm in providing the guarantee, but don't provide blindly. That's what I can say. You really need to understand that you need to do it, and you've analyzed, and then there is there's also the affordability part of it, where you're also looking at the government's affordability to that guarantee. You really need to say, in the worst case scenario, if anything went wrong, can government afford to take over this liability?
Thank you, Audrey. I'm already getting very harsh messages that I need to conclude this session. And I think it will be a disservice to the audience if I don't also just highlight what we are doing on a day-to-day basis to address some of the challenges that we've mentioned. So on a full-time basis, I lead the Miundo Misingi Hub, which is an infrastructure hub based in Nairobi, Kenya. And this hub was incorporated out of the need to address most of the challenges that we've said. So we run 5 key pillars that address some of the main challenges that we've seen in the infrastructure space. And we are motivated to do so because we think that private sector need to take the center stage going forward so that we can be able to originate more innovative, more sustainable solutions. But most importantly, these solutions should have the capacity to be replicated across the African continent. I don't see the reason why a solution in the water and sanitation sector in a town like Nakuru in Kenya cannot be replicated in a town like Gulu in Uganda or Arusha in Tanzania. We just need to tweak the solution to make it work in those towns. So I think this is something that Africa needs to consider, and we're working with partners both locally and internationally to make sure that we accelerate this process so that we see some progress going forward in terms of delivering better projects in the African space. So once again, thank you very much to the speakers of my panel. You'll agree with me that this has been a very insightful conversation. We definitely need to continue with this. And again, for the audience, thank you very much for keeping connected all through the conversation. And I want to wish you all a great afternoon, evening, and night, depending on where you're connected. Thank you very much, and it's back to you, Prima.
Excellent panel, Johnson and the rest of the team. Thank you so much for letting us know what are the challenges, right from, what are the challenges that governments are funding to what are the challenges that financials like, philanthropists are finding on the continent. It was also really good to hear from Audrey, who has a wealth of experience in working in an actual PPP unit and the creative solutions that they have found. Interesting to see governments trying to be creative and creating their own project preparation teams and carrying out feasibility studies, with even 2 projects currently going on based off of the feasibility study. So very, very interesting conversations. We're moving on to our third panel, which is our last panel of the morning. Just a reminder that we are registering for using 2 links, which is the morning session and the afternoon session. So right now we are moving on to making PPPs affordable and inclusive. How do we make public-private partnerships more affordable? How do we make them more inclusive? I'm going to invite Jairus Thomas from Planet Partnerships, who will moderate a panel, and we'll just hear conversations. Again, all the way we'll hear from, the African Development Bank, we'll hear from Water for Equity, we'll hear from, philanthropy, we'll also hear from public servants about, what has been done to make PPPs more affordable and inclusive. Welcome, Jairus, and enjoy the session.
Thank you, Prima, and thank you, Johnson, for that, and panelists for the very informative session. I guess addressing key challenges to financing PPPs is at the core of really affordability in PPPs and inclusivity within PPPs as well. So this is a good segue into our session now. Good morning and good afternoon to all. My name is Jairus Thomas. I'm a seasoned financial engineer and economist by profession with over 10 years of experience in the PPP and project finance space. I currently serve as the lead PPP financing expert at Planet Partnerships, and I've previously been the lead infrastructure financing expert at Genesis Analytics, which is the largest economics-based consultancy in Africa. And I have extensive experience in multiple sectors. This includes water and sanitation, property development, transportation, renewable energy, agriculture, pharmaceuticals, tourism, and digital infrastructure. So I have a well-rounded base of experience in PPPs across various sectors. And I played a key role in the successful delivery of PPPs in Sub-Saharan Africa, as well as those in Southeast Asia. So as we all know, and as we've discussed today, infrastructure really serves as a cornerstone of any economy, more specifically developing economies in emerging markets in Sub-Saharan Africa. To improve the well-being of individuals and to achieve the SDGs, what's required is more funding ultimately, and more investment, which we've discussed at length in the previous panel as part of the previous discussion. What we do, though, see is that there is a mismatch between the investment required by government due to affordability constraints and the actual investment that is made, which, again, as discussed, leads to severe infrastructural shortfalls and service delivery bottlenecks. Ultimately, what this results in is lower quality infrastructure, that is unaffordable to the citizens that receive the services. And this could be, for example, water and sanitation, or even access to reliable supply of electricity. And there are examples abound in countries in Sub-Saharan Africa, specifically in South Africa, where I'm based. This is an issue. So this session really aims to unpack and focus on the two critical issues being affordability in the public sector, which really centers on the fiscal capacity on the one hand, and on the other hand, affordability to the citizens receiving the services, because that is of paramount importance. And joining me today, I have a panel of esteemed experts who bring a wealth of knowledge and varied knowledge in this space. Firstly, we have Danlami Gomwak, who is the Principal Domestic Linkages Officer with the African Natural Resources Management and Investment Center of the African Development Bank. Danlami has experiences with PPPs for public infrastructure service delivery, infrastructure asset management, trade policy, and private sector development. Prior to the AFDB, he held roles at the Ontario Ministry of Infrastructure, the Tony Blair Institute, the Infrastructure Concession Regulatory Commission of Nigeria, as well as the National Competitive Council of Nigeria. We also have Njeri Kirumbi, who is the Regional Director for Africa at Water Equity, where she leads investments to financial institutions in Africa to ultimately expand access to financing for water and sanitation. Njeri is responsible for portfolio management, deal structuring, due diligence, strategy development, and she brings over 10 years of experience in impact investing in Africa. We also have Hugo Gossman, who is a PPP consultant for Angola PPPs at the United Nations Conference on Trade and Development, UNCTAD. Hugo is an engineer and specialist in public policies with expertise on economic regulation. He's a CP3P certified professional, and he has in his previous roles been the Ministry of Planning in Brazil, as well as an advisor in the Ministry of Energy. So Hugo is a vastly experienced individual from PPP perspective. Lastly, but certainly not least, we have Mabato Maboya, who is the current Chief Executive Officer of the Cyril Ramaphosa Foundation and chairperson of the Independent Philanthropy Association of South Africa. Mabato joined the foundation in 2015 as a strategy and partnerships exec. She managed key processes that enable the foundation to meaningfully respond to its development partners and beneficiaries. Mabato is an experienced communication and stakeholder relations professional with strong capabilities in research, strategy, and technical expertise. So that introduces our panel of experts, as I mentioned. To the audience joining us, thank you. We appreciate you joining us for this very important discussion. We want the session to be slightly immersive for you so that you feel part of the conversation. So please feel free to drop your messages in the Q&A below, and we will pick out some of these key questions to discuss as a panel later on. So to kick things off and to provide a bit of context on the importance of inclusivity and affordability in projects that involve private sector and philanthropy, we'll begin with some discussions and presentations, specifically from Njeri and Mabato. And I will then briefly present some of my experience and Planet Partnerships experience in PPP advisory in Sub-Saharan Africa. So without further ado, I will hand the floor over now to Njeri, who will give us her perspective from water equity point of view. Njeri, why is it crucial to consider the potential synergy between traditional public services and services that can be provided by the private sector? Can you share your perspective and experiences on how affordability can be achieved in PPPs? Njeri, over to you.
Thank you, Jairus, and the many others who've attended and participated in today's sessions. Where I would probably start off is we have had a lot of the challenges that PPPs have in Africa. And from this, I'd really like to highlight the point on lack of technical expertise and lack of affordable funding, because to me, that is where impact investors play a key role by bringing innovative financing instruments to accommodate the various risk appetite and provide more flexible funding. Usually from the private sector investment, there are usually two main broad categories. So there's a blended finance style, which is often used as a structuring approach rather than an investment approach. And in this case, you'd find organizations investing alongside each other while achieving their own objectives, whether we're talking about financial return, social impact, or a blend of both. Then you have the impact investors, and the impact investors have become more so important in the past years because the source of capital is mostly towards developmental projects. Their approach really involves having an intention to generate positive environment, social, and developmental impact alongside financial returns. Some of the main structures that have been seen in the Africa region, I would say would include fast loss capital or risk sharing instruments. And what you find with the impact investors compared at least to the other private sector players is they're willing to accept lower returns or they're more patient to their capital. There are a number of models that are available, I would say, in the region, and it's not one size that fits all. The main thing I would say is we really need to understand from the very onset the risk of the project and how to solve it. It also requires us being quite flexible with whatever options that there are, and also involving technical expertise at the very onset, because you'd find a lot of funding is flooded in the region, but we don't understand what the issue is, whether it's today or especially towards projects if it's 10 years from now. What has been common, at least for the Africa region and looking towards more so the financial sector, which has been the main focus that I've been looking at, is the provision of guarantees and risk sharing instruments. So for example, here, especially for different impact investors who work with financial institutions, they're able to provide additional guarantee support to the portfolio that these institutions would then on lend to. At Water Equity, as that is one of our main models, we partner a lot with the local players, whether it's different advisory firms, but also we rely quite closely to the financial institutions, because you'll find that these financial institutions are the ones that have expertise on ground, especially when you're looking at water and infrastructure projects or end borrowers in this particular segment. And being a fund that's global and of course looking at Africa, all countries are different. You can't, like I earlier said, you can't have one investment strategy that would apply across the different countries. So our main goal really is to see how much we can liaise with the local expertise, and we usually use this in terms of a twin track investment strategy. So funding, technical assistance that works hand in hand, and this way we are able to reach more countries, have more impact, but also be able to have a diversified investment pool that has a balance of risk and return. Thank you.
Thanks, Jerry. That's short and sweet. Thank you for sticking to the time. I guess that's definitely a useful start to set the scene, really. As we discussed, there is sort of this overlap from the discussion we had before to now when we talk about fiscal deficits. And a couple of the points that you mentioned are quite critical, and especially in water and sanitation, when it comes to offering guarantees and ensuring that financially we have sound mechanisms in place such that the project has the likelihood or the chance of actually being developed out such that it reaches the intended target. So the provision of water and sanitation services. So I think that's the really conduit between financing, as you mentioned, between some of the private players supporting and bolstering financial initiatives, and on the other hand, the affordability criteria that we speak about, because critically when it comes to tariffs, if there aren't guarantees in place and risks are not adequately priced, we are often left with projects that have to charge above market rates to recoup those costs. And without, again, this financing element, affordability becomes an even bigger problem to navigate. So I guess that perspective is very important. I'll now turn to Mabato to give us her views and perspectives, more from the philanthropy side, on both affordability, as we've discussed it now, as well as budgetary constraints and affordability from a public sector point of view. Mabato, over to you, and you're welcome to share your screen as I believe you have a presentation.
Thank you very much. Good afternoon, colleagues. I appreciate to be given this opportunity to just share with you our perspectives in terms of inclusion as well as affordability. And I think it's quite an opportune period to speak about this, because from a philanthropic organization perspective, I would like just to share on in terms of inclusion internal to the partnerships, as well as inclusion looking at those that will benefit from the programs and the projects that are implemented. And first and foremost, the first one that could be exclusionary is around definition of the PPPs, where it's generally believed that those that are coming outside of the public sector to contribute have a commercial intention. It's actually even in the regulations. So you find that where there's an altruistic intention around impact, that's where the disjuncture comes in. And the other one is around establishing very strong partnership principles. Looking at the autonomy of partners, when you look at philanthropic organizations, they have a created mandates from their donors and from the actual philanthropists, whereas a public sector and private sector would be drawing the mandate from different aspects. So bringing in that joint decision making and mutual respect in terms of understanding why the partners are coming into this PPP arrangement, and whether it is still a PPP arrangement in terms of how the laws and the regulations around public finance are organized around that, as well as looking at how we agree around monitoring and evaluation, looking at those objective measures around contribution and attribution of the impact. In terms of how we would have to, design the project goals, it's quite important to ensure that they form part or they respond to the integrated plans that countries, governments, and local councils, or those that are immediate to benefit from them, have structured, because it's no use to coming with a project that can achieve wonderful impact, but that is not linked to the integrated or the sustainable development goals that would move us forward. And lastly, I think on this point is around good governance and the structures which would enhance the level of trust amongst the partners. And mostly you find that the legislative environment has not really adjusted to the different types of funding, to the different types of capital that can be deployed. And when you're looking at the ordinary way of procuring services and procuring partnerships, there may be some limitations there. Just on affordability, I think key to it is around fiscally sensitive for successful delivery, particularly because we know that, the services that are offered are not going to be in a project phase forever. At some stage, the project stops. At some stage, we come out of that and we are on just delivering the services. And I think that fiscal sensitivity is mainly around the post-project maintenance and the financial capacity to implement. So it's not only the financial muscle around de-risking, but it's the actual infrastructure that is within the public sector to continue with the impacts of those programs, and to also make sure that the parties to the project understand that a budget should always be a funded budget for implementation and for maintenance of the project benefits. I'll just stop there, Jarius, because I think when we're listening to colleagues, even throughout the session, when we're speaking of PPPs, is mainly on an infrastructure lens. And sometimes from a philanthropic organization perspective, particularly sustainable, strategic philanthropy, is that we're looking at systemic change. And there's many aspects when we're talking infrastructure. So it's not only hardcore infrastructure, but it's infrastructure to maintain the impacts that projects would have achieved. Thank you.
Thank you, Mabato. I guess that's well said and also very succinct as well. From a philanthropy perspective, like you mentioned, the partnership model and the legal frameworks that govern these things need to be quite rigorous. And a key point that you just made also is that the life cycle element of a project needs to be accounted for, and that's often not taken into account adequately. So in my mind, if I have to relate the role of philanthropy and the support provided, it has to not only target the core development, but at the same time ensure that over a 20 or 30 or whatever finite period, the intended outcomes are achieved. So you mentioned also monitoring and evaluation. I think that's critical. I think in a world where we, keenly target developmental outcomes as part of SDGs, as part of climate change initiatives, forming monitoring and evaluation standards is quite critical. And those frameworks need to be robust frameworks that enable all stakeholders to adequately see exactly where we are in the process. So it's good to know and good to hear that philanthropy also has a role to play in strengthening these processes. Mabato, I'm just going to now shift over to a Planet Partnerships perspective on the subject, which in a lot of ways, I think, again, dovetails with some of the discussions we had previously and some of the key points that were mentioned now. So let me get into that. Okay, so this is just to give you a little bit of an overview of a subset of Planet Partnerships, really project pipeline.
Yeah. Just sorry to interrupt you. We can see the presenter mode from on our screen.
I see. Okay, let me just, apologies for that. Desktop one. Bit of a minor glitch, but we will fix that quickly.
If you go to your slideshow tab, you can uncheck the presenter mode.
Okay, just a second. I think if I do this and I full screen this, there we go. Can you see that now?
It's okay, just go ahead. We can still see the presenter mode, but we need to move on, yeah.
Okay, sake of time. Apologies for that.
Actually, can you just leave this screen on so we can actually see the bigger slide? So,
okay.
Yeah.
Can you now see it? That's fine. Okay, I'll just leave it like this.
Yeah.
There we go. Okay. So a Planet Partnership snapshot of some of the projects that we do from a portfolio perspective. And one of them is USAID's WAPPP 2.0, which aims to catalyze up to $400 million of finance and strengthen the creditworthiness of service providers, specifically in countries in Africa, like Ghana and Kenya, but also 8 countries globally. Importantly here, strengthening creditworthiness enables operational efficiencies to be realized. And in that way, we enable these utilities that provide, for instance, water and sanitation infrastructure in this case, to provide the service at a more cost-effective level. So getting to understand really what the core issues in service provision enables us to enables the infrastructure to result in more promising outcomes. Second to that is the Millennium Challenge Corporation Africa 50 Impact for Infrastructure Accelerator. And this is to identify and structure high impact transactions in 12 countries in Africa, ranging from $1 million up all the way to $100 million in various sectors. Importantly here, I think this portfolio aims to use Africa as a test case, and it hasn't been piloted globally and brought back to Africa, which is really, really nice to see, and it's a refreshing change for impact investing, and that's one of our projects as Planet Partnerships. Also, we work in Zambia, that's increasing access to water and sanitation through water and sanitation and hygiene enabling environment support. So we've spoken at RIGA about the enabling environment and some of the issues therein, but ensuring that legal processes and capacities of the utilities and institutional members match the requirements of development is critical here for us to provide these infrastructural investments in water and sanitation. Lastly, we also work in Botswana as Botswana Development Corp, and we provide them capacity building. I think we've mentioned capacity building and strengthening foundational elements of project scoping and design and training programs that target really ameliorating the skill set of these individuals. And what we found is that through this process, the BDC was able to more astutely determine how to invest money in ways that maximize impact. And that involves, stronger due diligence processes and other methods that, we bring into this capacity building. Just moving on also, a key part of what we do and what's important about achieving our goals with regards to affordability and inclusivity is to create governance frameworks that do not conform to standard processes. So in other words, we move from what we call an isomorphic framework or isomorphic pressures into unique frameworks. And these frameworks then enable governments to understand uniquely the challenges of sub-Saharan African countries and not necessarily adapt to best practice from around the world, but take insights from that. And there's three parts that we look at. It's systems and standards, which are procedural mechanisms and decision-making hierarchies. We then look at these institutions, which are really the rules of the game. So if we're looking at maximizing affordability and impact, what are the rules of the game in terms of customs and laws that regulate social action? And this forms a key part, again, of our process to strengthen governance frameworks. The last and most important thing, I think, which includes some of the elements I mentioned in institutions and systems, is the legal framework. So these are unique frameworks that are a result of really complex relationships between institutional and cultural stakeholders, and as well as political traditions. And these really uphold the cornerstone principles of development in PPPs. And we require sound fiscal management and accountability along the value chain. And this is core to the advisory services that we provide. And we've seen really beneficial results in prioritizing this framework as one of the key pillars in development. So I think we've all mentioned this at some stage, but it's very important from government affordability perspective to flesh out a little bit, how exactly we look at ensuring projects are affordable. And PPPs can be made more affordable. The term affordability really means something is fiscally viable for government. And that means the project is sustainable as a long-term balance sheet item, so it can be included on the balance sheet. And importantly, the approach that we take is a life cycle project finance approach to understand the present value of all the costs entailed. And I think we mentioned this earlier, but we develop robust, cash flow models and risk tools to calculate the whole of life cost to government. And by understanding that whole of life cost, governments can then set aside the necessary funds. And where funding is not available and the fiscus cannot easily subsume the requirement, we then look at alternative financing methods that we spoke about earlier in terms of support to catalyze financing, blended financing support, and others. And the link to this then is inclusivity, and inclusivity in the sense of value for money, value for people, and value for the planet. So we look at a triple bottom line. How is society impact? How is the environment impact? And ultimately, financially, does this stack up? And in order to achieve this really, from an affordability perspective, we need to have meaningful engagement with those at a grassroots level on the ground. So it's meaningful stakeholder dialogues that establish compensation mechanisms, for instance, and follow proper land acquisition processes, because these are very important. as Planet Partnerships, we construct willingness to pay studies. We look at methods of pro-poor tariff structures that use subsidies such that there's this cross-cutting, equitable provision of services to even those that are impoverished. We look at the environmental impact as well as the social impact, and that's also quite critical. Creating local jobs forms part of a mandate for many of these PPPs, and trying to insource where we can employment and using local firms is at the heart of really ensuring that some of these PPPs result in equitable outcomes. So that just gives you a little bit of a flavor to how we look at things from a Planet Partnerships perspective and really our portfolio. I think we've touched on a bit of the beginning stages of how philanthropy, private sector, and advisory can impact and look at PPPs in a way that prioritizes affordability. Let's now turn our attention to the viewpoints of a multilateral development bank. And my question now is for Danlami. Danlami has extensive experience on large project finance and PPP investments in Africa. Danlami, where there's a shortage of fiscal space, how can governments prioritize their spending in a manner based on national development plans or subnational development plans in a manner that maximizes the development outcome? In your line of work, are you seeing the strategic shift from domestic commercial banks interested in funding economic upliftment projects that deal with MSMEs, for instance? Danlami, the floor is yours.
Yeah, thank you, Jarius, and greetings to all the panelists and participants. I think you've asked sort of a two-pronged question, so let me try and tackle it. First of all, I'm from the Natural Resource Center, so I'll approach affordability from especially sub-Saharan countries that are resource-rich and rely specifically on a lot of the natural resource activities or value chains within their countries. You mentioned, you gave a few examples in your last slide, on which I'll jump on the MCC giving 100 million for 12 countries, the USAID WASH program, $375 million for Ghana, Kenya, and 10 other countries. And I'll perhaps use an example of the Presidential Infrastructure Fund in Nigeria, that's with the Nigerian Sovereign Investment Fund, that was derived from the gas, from the natural, liquefied natural gas, and that seeded it with 650 million. Just to show us on scale and prioritization. If we're talking 100 million within 12 countries and the kind of scale for infrastructure development, we're talking about a portion of the continent, we're saying Sub-Saharan, that can hold China and America. So the scale and the scope is very massive. So I'm happy with the two other panelists that touched on so many things that I would have touched on. So I'll try and limit it to perhaps where that fiscal space can be created from prioritization. So if we look at a situation where there's a potential possibility of setting aside a portion of what is received from the rents and the activities in the natural resource value chain specifically for infrastructure development, and we can take it in different paths, because I'm one of those that's also worked from a traditional procurement perspective. You have to get traditional procurement right to get PPP right. Because at the end of the day, we're talking about costing. It's because you've spent money to cost and you're looking at how you can make it efficient. Part of the challenges is the jump between traditional to PPP without that foundational knowledge of how do you procure and maintain an asset traditionally. And that jump is sometimes difficult to navigate. However, the strength of PPP using the natural resource sort of rents comes from the ability to leverage. PPP is actually a leveraging tool, where you can say, I have so much money, what can I seed, what can I attract from the private sector to sort of add? So imagine a scenario where you have 100 million. An asset or an infrastructure costs 100 million, but you can take 10 million and leverage in a PPP, in a well-structured PPP, I should add, and crowd in 90 million and then use the remainder for other assets. That's some of the beauty of a well-structured PPP in terms of how to deploy it. So part of the argument I'm trying to say is to look at existing resources and reprioritize, because what generally happens now is, like every government will tell you, nobody has enough resources. Even as a bank and many other MDBs don't struggle with resource allocation. but there is a sense of prioritization in order to use the PPP itself as a leveraging tool to crowd in further resources. Now, this boosts the ability to allow the government to bring an asset online faster, because even if a government tries to procure it traditionally, they can only put drips and drabs of the money and it may take them 5 to 10 years to construct. And as we all know, governments are good at constructing, but maybe a little bit not as good at maintaining. And that is where the PPP actually shines because of the life cycle, the maintenance, depending on well-proposed KPIs. So that interest is definitely there. There's always been there. As you said, there are regimes that have been done. I'll tackle the second portion of the question that you asked in terms of interest. It has been mentioned before, but I think we use a lot of corporate and balance sheet lending, which does not work a lot for SMEs. You mentioned interest for SMEs in terms of the commercial banks and things like that. Now, I'll tie it again to natural resource and infrastructure, where there are contracts, purchase orders and things like that, that can easily, the payment can be matched. I think Audrey spoke in the previous panel about matching payments. What happens generally is with cash flow financing, which is also a tool that PPPs enjoy, non-recourse lending, but that tool is not available for SMEs, where you can get a contract to supply a vendor, provide a service, and then be paid based on cash flow. And I think those sort of flexibility in terms of the tools need to be explored, and maybe a greater role of sort of enabling commercial banks, because I think the willingness is there, but the ability to take that risk and the liquidity to take that risk is not there. And that is where some of the resources that are kept aside from maybe resource rents and things like that can help to infuse the domestic environment, the domestic commercial banks. Because unless we get our domestic ecosystem, SMEs and vendors to be engaged in PPPs and other value chains, these costs will continue to be going higher and higher because you're bringing people that don't understand the risks. You're bringing vendors from different parts of the world, and those have costs. And the ability to strengthen domestic SMEs by providing them lines of credit that are cash flowed to them based on work and can ease the stress on commercial banks who simply cannot lend out based on corporate balance sheets, accounting and risk assessments. And I think that's an area that could better be fleshed out and maybe explored to see how that can be supported and pushed out further. And I think I'll stop it there if there are any further questions and I could jump in. But I think it's a very interesting what has been mentioned so far. I'm not too versed on philanthropy. I stick on public and infrastructure. So I think it's a very interesting learning process for me as well.
Thank you, Danami. Thanks for that. I think that's also very insightful and some good remarks there made on how finances should be or budgets can be reprioritized in a manner that maximizes or crowds in external sources of funding. I think as a financial engineer myself, I've encountered working with commercial banks where their risk appetites and risk models don't necessarily match that of
exactly, especially with balance sheet, but with a cash flowing model, which is very much similar to the PPP model. I think more SMEs can tap into a cash flow model of supporting based on the contracts you receive. But now that you've mentioned it, also brings the dual problem where maybe philanthropic money would come in handy. How do you get those SMEs ready to even win those contracts?
Right.
So getting to the point, because there's one thing when you win a contract, then we can cash flow and think about cash flow payment based on services rendered. But then how do you get the domestic SMEs primed up, ready, trained, capacitated, able to actually bid for those contracts? And that's where the role that I think a lot of maybe philanthropy and other sorts of resources can really help support that end of the equation.
Thank you, Danami. I fully agree with that. I think the project preparation that was discussed in the previous section is very important. There's different stages of PPP development, and the last leg of it really is ensuring affordability. It seems like affordability is the last leg, but in fact, if we turn it on its head and we look at a sort of a bottom-up approach, and we play back from the value being created by SMEs, creating employment, providing services that are in demand, increasing competition, and thereby lowering prices, If we work back from that and try and reprioritize, how do we get the financing, as you mentioned, to those SMEs, is a key challenge. And I think project preparation and development banks supporting project preparation, providing maybe first loss capital, de-risking the investment, enables those sort of value chains to be unlocked. And a very good point. I think we'll come back to it a little bit later on. I think I now have a question. I'm going to move on to Hugo to bring his expertise here. And Hugo, based on your experience in SADC and other regions, what we know is that the technical expertise of local developers and investors often undershoots, their requirements for certain large-scale PPPs. So locally, we don't have the talent pool to often pull off some of these developments. And what this causes is higher project costs ultimately. And you have international consortiums bringing in capital. There's a currency mismatch between project revenues and capital, which ultimately drives up project costs, and the end user ends up paying a lot more than they need to. So this is an affordability discussion also. Hugo, what can governments do to really foster local champions, and what can be done to increase local competition from your experience and your perspective in SADC and other regions?
Thanks, Jairus, for the question, and thanks to WAPPP for the invitation to take part in this important event. So before addressing this issue of technical expertise of local developers, I think that maybe it's interesting to make a few remarks, and to highlight different facets of your question. So first, I think we should assume that we are always aiming at following the best practices and as much as possible, which means that I would say decisions are made based on a certain set of rules and at least at some evidence, which is very important in the public sector. So having this in mind, I think that from the methodological point of view, if a decision was made by the public sector to deliver a project as a PPP, we presume that this route brings more value than other routes, be it value for money or value for people or value for the future, ideally the three of them. So from this perspective, I would say that it doesn't matter if the developer is local or not, because any other alternative, even not delivering the project, would be a worse choice for the country. But of course, this cannot be, the project cannot be seen as something isolated. So putting aside the discussion or the detail of who is implementing the project, I think in any case, as you said, the challenge of affordability, which has the two sides, you have already mentioned that, is always there. So the project should be affordable for the government and for the users. And I think in the context that we are discussing here, it's important to remind ourselves that we are implementing implementing PPPs in countries that have a limited space to charge users for the public services. So the role of the government as the provider of funding, or at least the mobilizer of funding, is really paramount for public infrastructure and services. So I can give you an example. Let's stick only to one sector, energy, for example. I have some experience on this, but in Angola, for example, 53% of the population does not have access to electricity. And the vast majority of this population is a vulnerable population. So who should carry the largest part of the burden to guarantee access to energy? It's the state, there's no doubt about that. And by the way, in this regard, Brazil has a very interesting experience of universalization of energy that maybe it's worth looking at as an inspiration. But so in the end of the day, the blanket short, the government will need to prioritize. I think Danlami has touched these points earlier, and you really need to limit the fiscal exposure of the country to the ensemble of PPPs, not only the firm commitments of government paid projects, but also the contingent liabilities related to all projects, guarantees, minimum revenues, or events, extraordinary events. So this is really a challenge. But getting back to your point of the expertise of local developers, I think that from a policymaker perspective, I would say that the key issue for the government is to address that the government should address is really to articulate development of projects with implementation of effective public policy. So You work on public policies to enable the environment for private participation in infrastructure, to foster the development of the local industry, and you try to tackle at the same time the development challenges. So this is a two-way movement. If you have an enabling environment, you create conditions for good projects, and if you have developed good projects, you make it possible to achieve the goals of your public policies. So to conclude, and back to the case of Angola, which is still an infant PPP market, what they have done in the last couple of years was pretty much work on the policy side, doing this package of reforms. They like including a new PPP legal framework, and with the support of institutions like UNCTAD, they have been investing a lot of time and energy to build capacity and expertise inside the government to be able to prepare and to launch a pipeline of PPP projects that are not only, let's say, sustainable, but also attractive to the public sector. So I think that most of the points have somehow been touched by the previous speakers, but this is my perspective as a former policymaker and someone that is working a bit in the southern part of Africa. Thank you, Jairus.
Thank you, Hugo. I mean, again, very, very valuable insights. And I think the key one there, which I don't think we touched on too deeply before, is really policy and the importance of ensuring that the enabling environment of which regulation and policymaking forms key part is one that enables the creation of value for investors and developers and local companies and businesses. I think it's vitally important. And that's one of the challenges that we see persistently before we get to the stage of crafting and developing technically, how do we implement a project? We first need to understand the legal bottlenecks that may preclude certain forms of project structures. And without understanding the full picture, like you mentioned now, unfortunately, we don't really get to development. And I think lots of examples, like you mentioned, Hugo, abound in Africa, where the provision of a critical service, like you mentioned, like electricity, should be the onus of governments in the public sector. It turns out, though, as we all know, in the case of South Africa, with the Electricity Supply Commission, that not properly forecasting and taking into account maintenance of critical infrastructure, amongst other things I might mention, which we don't have to delve in now, leads to a state where you cannot adequately provide citizens and businesses with enough electricity, which has a knock-on effect on GDP, which impacts those that run businesses and those that customers that purchase products from businesses all alike. And with vast levels of inequality in certain countries in Africa, I think getting to the roots of how do we set up legal frameworks to ensure that we don't get to sort of infrastructural shortfalls and critical service delivery shortfalls is vitally important. So your point is well noted, Hugo. I'm going to toggle back now to Danlami for another question. Danlami, you've worked on cross-border trade policies, and one of the issues that we persistently see is this, so to speak, gray market in Sub-Saharan Africa. So Sub-Saharan Africa is a destination for used or second-hand goods, such as vehicles in certain instances. What is your view on the primary problem from a domestic market impact, including whether this unofficial trade hinders growth, hampers domestic manufacturers, stalls technical innovation, and results in other negative externalities? I think that's the first part of it. And what can be done to remedy this issue? Do you believe that some of these remedies that you propose can have structural developmental outcomes? Over to you, Dan.
Yeah. Thank you very much, Jairus, for that question. I think this question is interesting because it allows you to talk for me to link it back to why it's so important to have local capacity, because that's really fundamentally what we're talking about here. I'm reminded of the phrase that nature abhors a vacuum. This trade that is happening with a great area, I think of it more as an opportunity. Let's stick to the vehicle example of manufacturing cars being imported. The first question you have to ask is, yes, there's a need. So it's going to happen. Entrepreneurs will seek opportunities. But then there's the aspect of, can you refurbish parts? Can you fabricate certain parts and start integrating and growing up the complexity of value chain There's some African countries that are already in some level of assembly or manufacturing. Ghana, Nigeria, I believe Kenya, I think Morocco as well. I've seen some news on that. They're already involved in some of these value chains of vehicles already. So that is happening. So where those sort of trades are happening, it's not as if it's a ban, and it's creating an opportunity. And it's once again, how can you support those industries that are already engaged with all the challenges, with all the power issues and everything, are already doing fabrication at some rudimentary level. Those are the companies, those are the institutions that can monkey branch and provide services into infrastructure, into other construction, into other industries. And that is sort of how to look at the challenge in terms of who are the people that are playing in this very, very unique area. How can we get support to them, either through philanthropic means or through cash flow means or through some governmental means? Because even like, for instance, in the oil and gas industry, you have a lot of training for welders. Sometimes they don't get jobs, sometimes they do, but those welders easily get into construction, and they're highly trained welders. And these are, and so you have to look at those opportunities that is created. Now, I know we could go, even with the garment industry. So for instance, garment industry is very big about that, but do we have a linkage between the cotton industry, the garment, the textile industry? Can we manufacture in mass? What I'm wearing now is considered haute couture, is bespoke. But it's bespoke is cheap in Africa, but it's very expensive in developed climes. How do we get the fact to mass production, to mass produce these things, have the sort of the manufacturing capability to do mass production outfits that can meet the needs of the people selling secondhand garments or selling secondhand cars? So one is the slight fabrication industrial story, and the other is similarly industrial story. And how do we get into this area? Because we know there's market. We're talking about it because there is a market, and as soon as if there's a market, it can be served. And as I said, nature abhors a vacuum. So what I'm trying to say is, I don't want to put it as a problem on what's something, but how to engage with it and how to sort of support the players within that market rule, because they didn't take that option because they wanted to. Something makes people make that choice. So I think for us as people in the development community is to go down to that level and say, how can support be provided to strengthen the people in that sector? And I hope I touched on a few things, but if I didn't, please bring it back, because I think it's very interesting and it keys back to the issues around supporting local domestic capacity and leveraging off the resources of many sub-Saharan African countries. I mean, we're talking about Angola. I mean, Angola is the same thing as the Nigeria and things like that, but are we specifically isolating funds for infrastructure, which can be used for PPP as an alternative procurement methodology, as well as supporting local players who can now engage in moving up the complexity value chain? And each country is at different capacities. Each country is at different capacity. Where Nigeria can put 650 million in a fund, maybe a small country can put 6 million, 5 million. That is all very good and a good place to start and grow. And I will say this because you mentioned cross-border. The African Continental Free Trade Agreement is online. And so this raises a lot of opportunities for those that can sort of set up the industries to provide goods and services cross-border. So many of these things right now will be the first group or institution that can properly support the players to engage and even engage internationally. I think will create vast jobs, vast opportunities for the region.
Danami, there's a specific question that came through on the chat, and I think it's a good time to answer it now because it relates directly to what you're speaking about. And the question reads, should PPP projects insist on local production and participation?
No. I don't think it's a case of insisting, because especially where you're using the money, I think it's a case of allocating certain, again, each country is at different capacity levels. There are certain sectors, if we're talking aviation or something highly technical, but we can build roads, we can build bridges. There are certain areas that I think, and depending on the local capacity, I'll say this, Jarius, for instance, when I sort of speak about cash flowing companies, how many the local companies have 10 of those cement mixers? They come at about 100,000 a pop. So if you talk about even building a construction project where you need 10 large cement mixers just to be able to engage in the procurement, that eliminates 90% of the sort of domestic players in the market. And that's where the support needs to come in for them to be able to get the plant and equipment for them to take advantage of the opportunities. We have engineers, we have road workers, we have all those things. Most of the PPP capacity that we're talking about here, we're all here, we're on the panel. You know, we've all worked with country agencies. The Infrastructure Concession Commission was my spiritual home in Nigeria before. So again, it's not about restricting or preventing, but allowing a level playing field by providing government interventions, perhaps using resources from from resources that is already an ongoing activity that can be isolated to support as opposed to being put in a general sort of budget. And there are several examples of these as well. Content management funds, this infrastructure fund that I just talked about. So perhaps I'll stop there.
Thank you, Danami. I think those are very interesting perspectives. I guess there are lots of opportunities to sort of bring local production back and strengthen the value chains locally. I do also think there is a role for comparative advantage. And as an economist myself, I look at these things where, you know, importing at times does make sense, you know, because of comparative advantage. But there is a role to play for development banks and governments to strengthen local capacity as a whole. And this will, you know, in turn result in, again, locally produced items, goods and services that are of superior quality, or at least as good quality as those being imported, and provided importantly at levels that are affordable. I think that's critical to our discussion here today, is how do we do things that result in more affordable outcomes instead of just creating local production, but in fact, the pricing is higher and you have a distorted market. So I mean, this discussion is quite a broad one, but I guess a very important one in the context of governments and development finance institutions creating and strengthening these local value chains. I want to bring Hugo back into the conversation now. And Hugo, can you share some of your experiences working specifically in the logistics sector in Angola regarding the authorities' approach to inclusion of low-income workers and women, including access to services such as health and education? Is there any consideration given to gig workers and other social issues in the planning of transport and logistics projects? Hugo, over to you.
Thanks, Charles. But I promise I will be briefer. I will be brief on this one. So just to address something that Danlami mentioned, because it's very interesting that our 2 points of views, maybe because of our previous experience, are very similar. And he, I think, gave very good concrete examples. So when we go out from the offices where we are talking about contracts and papers and go to the real life, we are talking about welders, we are talking about workers and everything. So when I mentioned articulating public policies and the implementation of projects, be it like PPPs or not, it's just like the role of the government is shown in this example that he gave. So how can we organize, you know, the country so that we identify what are the needs that these projects will have in terms of like companies, technology and everything, and then the government put in place something that will foster these areas. So this is what I mean by articulating. So working together, or maybe in the case of energy, when you bring the line and give electricity to people, you need to have actions bringing, for example, alternatives for people, I don't know, fishermen to have like their freezers store like fish, be able to sell, so you increase income. There is a really like concertation of public policies that can work together in infrastructure projects. So it's very nice. And the issue that he brings about comes to my mind the idea of maybe developing a regional capacity to develop PPPs in the region. So you have complementary capacities that you can like use in different countries, which are neighboring countries and etc. So about your question on logistics, this is a very interesting one, I would say, for two reasons. First, because logistics is not a traditional, logistics projects do not fall in the group of traditional PPPs. It's something that does not have long records. So I think it's a bit exciting to work with in innovative approaches like that. And also because logistics is a key factor not only for trade, but especially for development. So without logistics, it's very difficult to leverage development in countries. So Angola has introduced a new legal framework in 2021. It was very recent. They created an agency with the specific purpose and clear mandate to prepare and deliver logistic platform projects, and they are doing that through concession contracts. So if I would highlight maybe three aspects that I think are relevant to our discussion, is that first, from the very start, the agency has had a very strong commitment with capacity building of the staff, so having excellency on what they were doing, and this is what, for example, UNCTAD with funding from the EU is doing right now there. The other thing is that they narrow down, so prioritization, as mentioned before, they narrow down a very long list of projects that were inherited from the past, and they focused on just a few projects, I think 6 projects, that were the most important, that would add more value, and that would be able to connect the hinterland areas with consumption centers, or would have like some strategic location. And during this process, this is my third highlight to address specifically your question. During the process of preparation and tender of these projects, they brought the perspective of embedding in the contract aspects that would help moving forward towards achieving the SDG. So I can give you some examples. For example, taking care or having a special concern about the populations that would be in surrounding areas of these projects, not necessarily that would use the infrastructure, but that are in the region, so they need to be included in the process. In another dimension, for example, foster initiatives at the local level to make possible for local producers, for example, in rural areas, to be able to use the infrastructure, or not only use the infrastructure to send their products to the consumption center, which is mainly Luanda in this case, but also have access to capacity building, technical assistance, so that they can develop their activities, like production of fruits, for example, for the domestic market or even to export. So they have also this support. So you bring to the project also these issues related. You include, these populations in the equation, and this is a very interesting approach, and that was tailored for the country's reality. So they have very good results in a very short time span. So it's an interesting experience.
Indeed, thank you. Thanks. That's definitely good insight, Hugo. I'm cognizant of time and we're running short of time. I just want to bring back Mabato into the conversation. Mabato, we know that the Cyril Ramaphosa Foundation is a philanthropic organization that's dedicated to advancing programs that have various socioeconomic challenges. The question I have for you is, when it comes to partnerships between the private sector and the public sector, what value do these partnerships bring exactly? And based on your experiences with PPPs, what insights can inform our audience in making PPPs more accessible, affordable, and inclusive?
Thank you very much. Quite interesting conversations and inputs from colleagues here. One of the things that I think as philanthropic organizations we are able to assist with is that it's often assumed that public sector is able to partner with private sector and is able to partner with other multiple stakeholders and get it to work as efficiently as possible. Now, organizations such as ourselves have had to work with multiple stakeholders, and in order to to achieve the intended impact at the end of the day, and accommodating different mandates in partnering is one of the key things that I think philanthropic organizations are able to bring to the table. One of the examples that I have is around the large-scale education project that we went into a PPP partnership with one of the provincial departments. Now, key was that we spent over a year in terms of determining whether it's a PPP or not. And our interest was really not on whether it's a PPP or not. Our interest was we wanted to improve quality education and make sure that there's systemic change once we've done all of those elements. So eventually we were not a PPP. Eventually it was just enter a legal agreement because it was a rent-to-rent co-funding program with a government department that would create an innovative model that would be efficient in improving quality education, which is not always tangible when you come and look for value for money and those immediate results. So flexibility, entrepreneurial approach to delivering infrastructure, understanding that after the infrastructure, the services attached to it. So in a sense of education, for instance, in this aspect, it's very easy to construct classrooms and build schools, very easy. But to ensure that the quality of education delivered through the infrastructure requires you to do other things as well. And so we piloted what we called a district whole school development model, where we targeted all non-fee paying schools in a particular district and worked together with the Department of Education and said, what are your priorities? We have tried and tested models that we have seen have worked over the years to fast track improving that. And we think that if we work together, we can meet each other and attract other private sector partners who sometimes have a low trust deficit in working with, say, public sector departments, especially when they're not looking for a direct commercial return, but are just looking for a social license to operate. So all of those dynamics, when they come in, we understand that it will take time because the accountabilities are different. And we know that the public sector does not always have an appetite to pilot and test innovative ways of doing things. And I think working with philanthropy, because of the capital that is quite patient and often has higher risk tolerance around failure of things not working, that's one of the best ways that we can bring value into the partnerships. But I really think that around regulatory terms, and I understand the field is really developed, but sometimes just that could spend a lot of time on technicalities of whether we understand what is it that we are entering into and whether the agreements make sense. So yeah, that's just my input looking at the time. Thanks.
Thank you, Mabato. I'm cognizant again, we're running out of time. I've got one final question for Njeri to bring your final perspective on how exactly water equity, from a private sector capital perspective, what measures are in place to ensure that development outcomes are equitable and inclusive when it comes to water and sanitation?
Thank you for your question. I think I'll also combine it with some of the main comments that Ndalami has brought out, especially around ensuring that micro businesses and also SMEs are bankable. So I bring this from the aspect of working quite a lot with commercial banks who would then lend to such types of institutions. And what you find that is really important is the technical expertise. Most investors, at least in Africa region that are working with the commercial banks, the technical expertise is only at the level of the bank or the financial institution that you're on lending to or investing to. We necessarily don't go down to the SMEs and the micro businesses. And this is where now water equity has also taken into consideration, especially within the water sector. So one of the main things that we do is, for example, here in Kenya, where the governance around the water sector and utility companies is quite developed. We work a lot with the Association of Water here in Kenya and the different water utility companies to help them understand what exactly these banks are looking for to be able to finance them, to train them on how they need to keep their records or basically how to improve their structures and business model for it to be sustainable, which, for me, it's a key thing, not just to look at where the money is going as a direct credit risk, but really broaden the aspect of where is the impact and see how one can work towards improving the impact, but also the financial viability of these end borrowers, as opposed to just focusing from a high level perspective. Thank you.
Yeah, thanks, Njeri. It's almost 1 o'clock, and unfortunately, we've come to pretty much the end of our session. I think the audience probably has, and I've seen some questions coming through. I'm sure we'll engage with these in upcoming dialogues and other forums that are available to answer these important questions. I think we've learned a lot today. There's a lot of cross-cutting themes and topics about affordability and inclusivity and how really private capital investments such as water equity and philanthropy and development finance can all be weaved together in a way that creates project structures, importantly, that lead to infrastructure developments that provide affordable solutions. And there are various elements that need to be targeted critically when it comes to these things, is merging really the element of collaboration between the government and the private sector, because it is a partnership with differing agendas, and ensuring that all parties involved are, basically on song is vitally important. We also learned that prioritizing government budgets and reprioritizing them in a manner that can crowd in alternative investments is vitally important and can yield more affordable and inclusive results. I think we cannot discount the role of philanthropy in the space in terms of providing services that cut across really the lower end of the income spectrum, the lower LSMs in Sub-Saharan Africa. And it's vitally important that government and philanthropy and private investors all collaboratively work together to ensure that solutions are crafted according to frameworks that can actually be implemented. So very important that we look at using tried and tested frameworks that have shown to yield results. So to all the panelists, thank you very much. Your expertise and insights are completely invaluable. I'm sure we could spend the whole day speaking about this. Just for the audience, we will take a 30-minute interval, and we will be back at 1:30 for the next session. So thanks once again to everybody that joined. And I think that's it for us for now. Prima, I think that's back to you.
Thank you so much, Jairus. Thank you so much for all the panelists. I think that was an amazing discussion. It was good to hear, especially from the impact investors who are telling us that it's very easy to construct, but how do you deliver the actual impact? So that was a really, really, really good discussion. Thank you so much. Thank you, Hugo, Danlami, Mabato, and Jerry. A very awesome discussion. At this point, we're going to break, like Jairus has said. I think JC has some information in terms of registering for the next session, because there are 2 links. So I will hand over to JC, and you can pass on the information, and then I think this link will close and we'll open the new link. But over to you, JC.
Thank you very much, Prima. You are a wonderful master of ceremony, I have to say. Every single session this morning was absolutely rich and beautiful. So I'm very, very proud of what we have put together today. For this afternoon, I have shared the link for the registration. Probably you've already registered, but just in case, it's in the chat. And for those who are considering to join our effort to improve public-private partnerships, at the very bottom, well, first, one thing you can do is here, of course, click on join us, and then it gives you the reasons why you should join. And then at the very bottom, here you can see all the membership benefits, but at the very bottom, you can follow a couple of information sources that you may not be aware of yet. So we have a bi-weekly news, a WAPP news. We have a PPP market update that comes once a quarter. We have the WAPP magazine, where we share information about PPP units, about interesting projects. So feel free to share information with us, and the PPP Times, where we construe the 10 best articles every week. Every other week we share that. You need to subscribe to these. We can't push that information unless you have registered for that. So with that, I suggest we reconvene at 1:30 Johannesburg time, and I'm very much looking forward for a continued high quality event like we've had this morning.
Thank you very much, JC. So we can close this link, and please join on the second link that was shared with you, and we'll see you at 1:30 for the networking session. Thanks, everybody.